Hello there, and welcome. I'm so glad you found your way here tonight. Before we begin, take a moment to get comfortable. Adjust your pillow, let your body settle into whatever surface is supporting you right now. Where in the world are you watching from? A quiet bedroom where the city lights filter through your curtains. A cozy corner where the day is finally winding down. Wherever you are, you're welcome here. Tonight, we're going to explore one of the most significant economic events of our lifetime, the 2008 financial crisis. We'll discover how a housing bubble in America grew so large it nearly collapsed the entire global economy, understand the human decisions and systemic failures that allowed it to happen, and contemplate what it revealed about the structures that govern our financial world. This is a story about mortgages and mathematics, yes, but it's also a story about human psychology, institutional blindness, and the curious ways that greed and fear can compound into catastrophe. But don't worry, this isn't going to be a panic-inducing recounting of economic collapse, filled with alarming statistics and dire warnings. Instead, we'll move slowly and carefully through the timeline, examining each piece of the puzzle with patience and clarity. We'll understand how smart people made terrible decisions, how good intentions paved roads to disaster, and how a crisis that seemed to appear suddenly had actually been building for years. By the end, I think you'll find that while the crisis was complex, the core story is remarkably human and understandable. If you enjoy these calm explorations of history and economics, a like and subscribe really helps reach others seeking the same peaceful way to end their day. And to those already subscribed, thank you for being part of this community. So settle in. Let your shoulders drop. Take a slow breath, filling your lungs completely, then releasing slowly. And let's begin our slow drift through one of the most transformative moments in modern economic history. There's nowhere you need to be, no urgency required. Just listen and let the story unfold piece by careful piece. Let's begin not with numbers or markets, but with something deeply human, the dream of owning a home. For generations, home ownership has occupied a special place in American culture, representing stability, success, and belonging. It's where you raise your children, where you build memories, where you plant roots both literal and metaphorical. By the late 1990s and early 2000s, this dream was being actively encouraged by politicians across the political spectrum. President Clinton spoke of expanding home ownership. President Bush declared an ownership society where more Americans could own their own homes. These weren't cynical promises. They reflected a genuine belief that home ownership was good for individuals, good for communities, good for America. The statistics seem to support this optimism. In 1994, the home ownership rate in America stood at about 64%. By 2004, it had climbed to nearly 69%, representing millions of new homeowners. Families who had previously rented were now buying houses. First-time buyers were entering the market in record numbers. In many neighborhoods, the landscape was changing as renters became owners, as transient populations became permanent residents. The government supported this expansion in multiple ways. The Federal Housing Administration insured mortgages for lower-income buyers. Fannie Mae and Freddie Mac, government-sponsored enterprises, purchased mortgages from lenders, providing them with capital to make more loans. Tax deductions for mortgage interest made homeownership more affordable than renting for many families. The entire system was designed to encourage, facilitate, and reward home buying. But beneath this expansion was a question that few people were asking loudly enough. Were all these new homeowners actually able to afford their homes? Not just in the moment of purchase. when low initial interest rates made monthly payments manageable, but over the long term when those rates might adjust upward, when job situations might change, when life's inevitable uncertainties might arrive? The answer to that question would eventually shake the foundations of the global economy. But in the early 2000s, with home prices rising steadily, with the stock market recovering from the dot-com crash, with unemployment low and confidence high, it seemed almost unpatriotic to suggest that the home ownership dream might be built on unstable ground. People were buying homes, prices were rising, and everyone from mortgage brokers to Wall Street executives to government officials seemed to agree that this was exactly what a healthy, growing economy looked like. The machine was working beautifully, or so it appeared, and very few people were looking underneath to see if all the gears and mechanisms were actually as sound as they seemed. To understand what happened, we need to understand how the mortgage system traditionally worked, and how it began to change in fundamental ways. Imagine you want to buy a house in 1985. You walk into your local bank, probably a bank where you already have your checking account, maybe where your parents banked. You sit down with a loan officer who reviews your financial situation, your income, your debts, your savings, your employment history. The bank is careful because this bank will hold your mortgage for the next 30 years. If you default, if you can't make your payments, the bank loses money directly. So the bank has every incentive to ensure you can actually afford the loan they're giving you. This system created natural caution. Banks understood that their own financial health depended on making good loans. They required substantial down payments, typically 20% of the home's value. They verified your income carefully. They looked at your debt-to-income ratio, ensuring your mortgage payment wouldn't consume too much of your monthly earnings. They were, in essence, betting on your ability to repay, and they took that bet seriously because it would carry the consequences. But in the 1990s and accelerating in the 2000s, this system underwent a profound transformation. Banks discovered they didn't have to hold mortgages anymore. They could originate a loan, collect fees for doing so, then immediately sell that loan to someone else. The loan would be packaged with hundreds or thousands of other mortgages, turned into a security, and sold to investors around the world. This process, called securitization, had existed for decades, but it had mostly been used for relatively safe conventional mortgages. What changed was the scale and the scope. Suddenly, banks were originating mortgages not to hold them, but to sell them. The bank's incentive structure shifted fundamentally. They made money on volume, on the fees charged for creating loans, not on the long-term performance of those loans. Think about what this does to caution. If you're a loan officer and you know that your bank will sell this mortgage next week, that someone else will bear the risk if the borrower defaults, how carefully do you scrutinize the application? The immediate incentive is to approve more loans, to generate more fees, to keep the machine running. The long-term risk has been transferred elsewhere. This wasn't entirely new, but the scale was unprecedented. By 2006, approximately 80% of new mortgages were being sold into the secondary market, bundled into mortgage-backed securities and distributed to investors globally. The connection between the lender and the borrower, the relationship that had enforced discipline for generations, had been severed. And into this new landscape walked a variety of new mortgage products, innovations that would have seemed bizarre or reckless under the old system, but which made perfect sense if your goal was simply to originate loans, collect fees, and pass the risk to someone else. We'll explore those products next, but for now, understand this fundamental shift. The system that had once aligned incentives toward caution had been restructured to reward volume, and that change would prove catastrophic. The word quote one sounds technical, almost antiseptic, but it represents something quite specific. Loans made to borrowers who don't qualify for conventional mortgages, people whose credit scores, income levels, or employment histories suggest higher risk of default. Subprime lending had always existed in small quantities, serving people who needed credit but couldn't access traditional banks. But in the early 2000s, subprime lending exploded. In 2001, subprime mortgages represented about 7% of all mortgage originations. By 2006, they represented over 20%. In actual numbers, this meant roughly $600 billion in subprime mortgages were being issued annually at the peak. But the real innovation wasn't just lending to riskier borrowers. It was the creation of exotic mortgage products that made home ownership appear affordable even when it fundamentally wasn't. Let me describe a few of these products, and as I do, consider whether they sound like sustainable ways to finance the largest purchase most people will ever make. The adjustable rate mortgage, or ARM, offered a low initial interest rate that would later adjust to a higher rate. A borrower might pay 3% interest for the first 2 years, then see that rate jump to 7 or 8%. The initial payments were affordable, the later payments less so. But the initial payments were what mattered for qualifying, and the lender would be long gone before those adjustments kicked in. The interest-only mortgage allowed borrowers to pay only the interest for a period of years, not touching the principal at all. You could live in a house, make monthly payments, and owe exactly the same amount 5 years later that you owed on day one. This made monthly payments lower, making homes seem more affordable, but it meant building no equity, no ownership stake. Then there was the option ARM, perhaps the most exotic product of all. Borrowers could choose each month how much to pay: a full payment covering principal and interest, an interest-only payment, or a minimum payment that didn't even cover the month's interest. If you chose the minimum payment, the unpaid interest was added to your loan balance. Your debt actually grew larger each month. This was called negative amortization, and it meant you could owe more on your house after 5 years of payments than you owed when you bought it. Consider the psychology this created. A family that couldn't afford a conventional 30-year fixed mortgage could now afford a much larger house using one of these products. The monthly payment fit their budget, at least initially. The loan officer, incentivized by volume, approved the application. The mortgage was immediately sold to Wall Street, bundled with thousands of others, and dispersed to investors who may not have fully understood what they were buying. And there was one more innovation: the no documentation loan, sometimes called a liar's loan. Borrowers could state their income without providing verification, without showing tax returns or pay stubs. If you wanted to claim you earned $100,000 a year when you actually earned $40,000, you could do so, and in many cases, no one checked. By 2006, nearly half of all subprime mortgages were low documentation or no documentation loans. These products weren't designed by evil people trying to destroy the economy. They were designed by clever people trying to expand access to home ownership, to make loans to people who wanted to buy homes, to keep the machinery of finance running smoothly and profitably. But they fundamentally disconnected the ability to make initial payments from the ability to sustain those payments over time, and that disconnection would prove devastating. While these new mortgage products proliferated, something remarkable was happening to home prices themselves. They were rising, steadily and seemingly inexorably, year after year after year. Between 2000 and 2006, the median home price in America roughly doubled. In some markets, the increases were even more dramatic. In Miami, Phoenix, Las Vegas, and parts of California, prices tripled or quadrupled in just a few years. A house that sold for $200,000 in 2000 might sell for $400,000 in 2003 and $600,000 in 2006. This created a powerful psychological dynamic. If you owned a home, you were getting wealthier simply by sitting still. Your house was appreciating, building equity without any effort on your part. You could take out a home equity loan, borrowing against this appreciation, and use that money for renovations, vacations, cars, or paying off other debts. Your home became not just a place to live, but an ATM dispensing borrowed money backed by ever-increasing value. If you didn't own a home, you felt increasingly desperate to get into the market before prices rose even further. Waiting seemed financially irresponsible. If homes were appreciating 10 or 15% annually, every year you delayed buying cost you real money in future equity. This urgency made risky mortgages seem reasonable. Even if you could barely afford the initial payments, even if you needed an exotic mortgage product to qualify, home price appreciation would save you. In 2 years, your house would be worth more, you could refinance into a better mortgage, and everything would work out. This belief became self-reinforcing. Rising prices justified risky borrowing, which increased demand, which pushed prices higher, which justified more risky borrowing. Speculators entered the market, buying houses not to live in but to flip, to hold for a few months and sell at a profit. In some markets, a significant percentage of purchases were speculative, people treating houses like day-traded stocks. Real estate agents, mortgage brokers, appraisers, and home builders all benefited from rising prices and increasing volume. An entire ecosystem of professionals had every incentive to keep the bubble inflating. An appraiser who gave conservative valuations might not get called for future appraisals. A mortgage broker who was too cautious about borrower qualifications might lose business to less scrupulous competitors. A real estate agent who suggested the market might be overheated might lose clients to more optimistic colleagues. And there was historical precedent for optimism. American housing prices had never declined nationally, not since the Great Depression. There had been regional downturns, but never a broad, sustained national decline. This history created confidence, a belief that housing was fundamentally different from other assets, that it couldn't crash the way stocks could crash. Economists would later identify this as a classic bubble, displaying all the characteristic symptoms: rapid price increases disconnected from underlying economic fundamentals, broad participation by both sophisticated and unsophisticated investors, increasing use of leverage and debt, rationalizations for why quote for and a collective unwillingness to consider the possibility of decline. But in 2005-2006, the peak years of the bubble, most participants weren't thinking about bubbles or crashes. They were thinking about the home they could finally afford, the equity they were building, the wealth they were accumulating, the dream they were achieving. The machine was working, prices were rising, and questioning the sustainability of it all seemed like pessimism, perhaps even un-American. While Main Street was buying houses with exotic mortgages, Wall Street was performing a kind of mathematical alchemy, transforming those risky mortgages into supposedly safe investments. The process began with securitization, which we've touched on, but let's understand it more deeply. Imagine a bank has originated 1,000 mortgages. Some are to borrowers with excellent credit, some to borrowers with good credit, and some are subprime loans to risky borrowers. The bank pulls all these mortgages together and creates a mortgage-backed security, or MBS. But here's where it gets interesting. The bank doesn't just create one type of security from this pool, they create tranches, slices, each with different risk profiles. The senior tranche gets paid first from the monthly mortgage payments coming in. This tranche is considered very safe because even if some borrowers default, the senior tranche holders still get paid. The middle tranches, called mezzanine, get paid next. They carry more risk but offer higher returns. The bottom tranche, called equity or toxic waste, gets paid last and absorbs the first losses if borrowers default. Credit rating agencies, companies like Moody's, Standard & Poor's, and Fitch would then rate these tranches. The senior tranches, even though they were backed by pools that included subprime mortgages, would often receive AAA ratings, the same rating given to US Treasury bonds. The mathematical models said that even if individual mortgages defaulted, the senior tranches were so well protected by the tranches below them that they were essentially risk-free. But Wall Street didn't stop there. They created something called a collateralized debt obligation, or CDO. A CDO would take the mezzanine tranches from multiple mortgage-backed securities, pool them together, and slice them into new tranches. Some of these new tranches would also receive AAA ratings, despite being created from pieces that were themselves risky. Think about this carefully. You take risky mortgages, pool them, and through mathematical slicing, create some pieces that are rated AAA. Then you take the risky middle pieces from multiple pools, combine them, slice them again, and create new AAA-rated pieces. You've essentially transformed risk through complexity, through mathematical modeling, through diversification assumptions. The rating agencies were complicit in this process, but perhaps not maliciously. They used mathematical models that assumed housing prices would continue to rise, or at least not fall nationally. They assumed defaults across different geographic regions wouldn't correlate, that a foreclosure in Florida didn't make a foreclosure in California more likely. These assumptions seemed reasonable based on historical data, but they would prove catastrophically wrong. Moreover, the rating agencies had a conflict of interest. They were paid by the very institutions whose securities they were rating. An agency that gave conservative ratings might lose business to competitors willing to be more generous. This wasn't corruption in the traditional sense, but it created subtle pressures toward optimism. Financial institutions around the world bought these securities. Pension funds, insurance companies, banks, hedge funds, foreign governments all purchased mortgage-backed securities and CDOS, trusting the AAA ratings, trusting the mathematical models, trusting that Wall Street had genuinely figured out how to transform risk into safety. Some of these institutions barely understood what they were buying. The products were complex, opaque, difficult to value, but they offered higher yields than Treasury bonds while supposedly carrying similar risk. In a low-interest rate environment, where safe returns were meager, this seemed like found money, like a free lunch delivered by financial innovation. There were skeptics. People who looked at the housing market and the exotic mortgages and the complex securities and felt uneasy. But they were few, and their warnings were drowned out by the roar of profits, by the confidence of mathematical models, by the reassurance of AAA ratings, by the seeming evidence of ever-rising home prices. Let's pause here and consider the human element in all of this. Because the crisis wasn't primarily caused by bad people or even by bad intentions. It was caused by a system that created incentives that, when followed rationally, produced collectively irrational outcomes. Consider the mortgage broker, the person who sits across the table from a hopeful home buyer. This broker earns a commission on each loan originated. A larger loan means a larger commission. An exotic mortgage product, like an option ARM or an interest-only loan, might carry a higher commission than a conventional 30-year fixed mortgage. The broker's income depends on volume and on the types of loans originated. Now, this broker meets a family that wants to buy a house. Under traditional lending standards, they don't qualify. Their income is too low, their debt's too high. But using an option arm, using stated income without verification, the broker can make this loan happen. The family gets their dream home, the broker gets a commission, the family is happy, the broker is happy, everyone wins. Except, of course, if the family can't actually afford the house once the interest rate adjusts, once the payment shock arrives. But that's 2 years away, 3 years away. In the immediate present, everyone's incentives align toward making the loan happen, move up the chain. The investment bank that purchases mortgages and securitizes them also operates on incentives. They make money on volume, on fees charged for creating and selling mortgage-backed securities. The more mortgages they can buy, the more securities they can create, the more fees they generate. Their traders and executives receive bonuses based on short-term profits, not on the long-term performance of the securities they've sold. If you're a trader at an investment bank in 2005 and you express caution about the housing market, suggest slowing down mortgage securitization, you're arguing for lower profits, smaller bonuses, less success by the metrics that matter in your world. Your colleagues at competing banks aren't exercising caution. They're generating higher returns, receiving larger bonuses. The market rewards aggression, not prudence. The appraisers who value homes also face pressures. If you consistently give conservative valuations, if you tell a buyer or a seller that their house is worth less than they hoped, you might not get repeat business. The appraiser who comes in with a higher number, who helps make deals happen, gets called again. Even borrowers, the families buying homes, operated under powerful incentives. The tax code rewards homeownership. Social pressure celebrates it. Home price appreciation makes it seem wise. Financial advisors, friends, family members all encourage buying. Renting feels like wasting money when you could be building equity. This is the insidious nature of systemic risk. Each individual actor following their rational self-interest, making decisions that benefit them personally and immediately, contributes to a system that is collectively unstable. No conspiracy is required, no evil mastermind, just normal human beings responding to the incentives placed before them. And the incentives all pointed in the same direction. Originate more loans, inflate more prices, create more securities, take more risk, keep the machinery running. The rewards were immediate and tangible. The risks were distant and abstract. This is how rational people built an irrational system. How good intentions paved a road to crisis. There were regulations that might have constrained this behavior, rules that might have limited risky lending or excessive leverage. But regulators faced their own pressures. Aggressive regulation might slow economic growth, might increase unemployment, might make politicians unhappy. And there was a prevailing ideology, particularly strong in these years, that markets were self-regulating, that financial innovation was positive, that regulatory intervention was usually harmful. Alan Greenspan, chairman of the Federal Reserve from 1987 to 2006, embodied this philosophy. He believed that market participants, acting in their own self-interest, would naturally avoid excessive risk because they would bear the consequences. This belief would prove tragically mistaken, but it was sincere. it was intellectually grounded, and it was widely shared. Beyond the traditional banks, beyond the mortgage brokers and investment banks we've discussed, there existed a vast shadow banking system, entities that performed bank-like functions, but operated with far less regulation and far more leverage. Traditional banks are regulated carefully. They must maintain certain capital ratios, keeping reserves to cover potential losses. They are subject to regular examinations by federal regulators. They have access to emergency borrowing from the Federal Reserve, but this access comes with string attached, with oversight, with constraints on risk-taking. The shadow banking system, by contrast, operated in a regulatory twilight zone. Investment banks, hedge funds, structured investment vehicles, money market funds and other entities could borrow enormous sums, invest in risky assets, and do so with minimal regulatory oversight. Consider the concept of leverage, which simply means using borrowed money to amplify returns. If you have $1 million and you invest it directly, earning 10%, you make $100,000. But if you borrow $9 million, invest the full $10 million, and earn 10%, you make $1 million. Your return on your original capital isn't 10%, it's 100%. Leverage amplifies gains magnificently. Of course, it also amplifies losses. If your investment loses 10%, you've lost your entire $1 million, and you still owe the $9 million you borrowed. This is leverage's double edge, and shadow banks were wielding it aggressively. By 2007, major investment banks were operating with leverage ratios of 30-1 or even higher. For every dollar of their own capital, they had borrowed $30. This meant a 3% decline in the value of their assets would wipe out their entire capital base. They were operating with almost no margin for error, and they were investing heavily in mortgage-backed securities and CDOS. These institutions funded their operations through short-term borrowing, often overnight loans from money market funds and other sources. Each morning, they would borrow billions of dollars. Each evening, they would repay those loans, then borrow again the next morning. This system worked beautifully as long as lenders maintained confidence, but it was extraordinarily fragile. If lenders became nervous, if they decided not to renew their loans, these institutions could face instant liquidity crises. Structured investment vehicles, or SIVs, were another component of the shadow system. These were entities created by banks to hold assets off their balance sheets, avoiding certain regulatory requirements. An SIV might issue short-term commercial paper, use those funds to buy long-term mortgage-backed securities, and pocket the difference in interest rates. It was borrowing short and lending long. A classic banking function, but without the capital cushions or regulatory oversight that traditional banks faced. Money market funds, which many Americans used as safe places to park cash, were also part of this system. These funds were supposed to maintain a stable value of $1 per share, investing in safe, short-term debt. But they were reaching for higher yields, investing in commercial paper issued by institutions exposed to subprime mortgages, introducing risks that investors didn't fully understand. The entire shadow banking system, by some estimates, had grown to rival or exceed the size of the traditional banking system by 2007. Trillions of dollars flowed through these channels, largely beyond regulatory sight, highly leveraged, deeply interconnected, and fundamentally dependent on confidence and liquidity. Regulators, to the extent they paid attention, largely believed this system was self-correcting. These were sophisticated institutions run by smart people with strong incentives to manage risk carefully. the market would discipline excessive risk-taking through pricing mechanisms. If an institution took too much risk, lenders would charge higher interest rates or refuse to lend, forcing prudence. This belief overlooked a critical reality. In good times, when asset prices are rising, when defaults are low, when confidence is high, market discipline evaporates. Lenders compete to provide cheap capital. Risk-taking is rewarded, not punished. Caution looks like cowardice or incompetence. Everyone assumes that everyone else has done proper due diligence, that someone, somewhere, is minding the store. And critically, these shadow institutions were connected to traditional banks, to pension funds, to money market funds that ordinary Americans relied on. This shadow system wasn't truly separate. It was intertwined with the entire financial ecosystem, creating channels through which panic could spread, through which a crisis in one corner could cascade everywhere. The story we've been telling might seem like an American story, a tale of American housing and American banks and American borrowers. But the crisis was global from its inception, woven into the fabric of international finance in ways that would prove consequential. European banks, it turned out, were enormous buyers of American mortgage-backed securities and CDOs. Banks in Germany, France, the United Kingdom, Ireland, Spain, and elsewhere had invested heavily in these products, attracted by their AAA ratings and their yields. Some European banks had balance sheets with more exposure to American subprime mortgages than many American banks. Why would a German bank buy securities backed by mortgages on houses in Florida and Nevada? Several reasons, all seemingly rational at the time. First, the securities appeared safe, rated AAA by respected agencies. Second, they offered higher returns than many European investments. Third, they provided geographic diversification, spreading risk across the Atlantic. Fourth, and perhaps most importantly, European banks were flush with cash and struggling to find sufficient investment opportunities in their home markets. The euro, introduced in 1999, had created unprecedented financial integration in Europe. Capital flowed freely across borders, interest rates converged, banks in Germany could lend easily to borrowers in Spain or Ireland or Greece. This integration created opportunities but also vulnerabilities, channels through which shocks could propagate rapidly. Some European countries were experiencing their own housing bubbles. Spain and Ireland in particular saw explosive growth in construction and home prices, fueled by cheap credit and optimism about economic convergence within the European Union. Banks in these countries were lending aggressively for real estate development, creating vulnerabilities that would parallel and compound America's crisis. Asian investors, particularly in Japan and China, also purchased large quantities of American mortgage-backed securities. Sovereign wealth funds, central banks, and private investors all participated. The global appetite for these securities was insatiable, which helps explain why Wall Street kept producing them in ever greater quantities. This global dimension meant that when the American housing market began to crack, the tremors would be felt worldwide, not as distant aftershocks, but as primary impacts. A foreclosure in Las Vegas could affect a pension fund in Amsterdam, a bank in Dublin, a construction company in Madrid. The financial system had become so interconnected that genuine isolation was impossible. Moreover, the mathematical models that supposedly made these securities safe relied on diversification assumptions that globalization undermined. The models assumed that a downturn in American housing wouldn't correlate with downturns elsewhere, that defaults would be scattered and manageable. But if global investors had all made similar assumptions, all invested in similar assets based on similar models, then a crisis would affect everyone simultaneously. There's a bitter irony here. Globalization and financial innovation were supposed to distribute risk, to make the system more stable by spreading exposure across many institutions in many countries. Instead, they distributed risk in ways that distributed panic, that ensured a crisis in one location would become a crisis everywhere. International financial institutions, the International Monetary Fund and the Bank for International Settlements, had some visibility into these building risks. Reports were written, warnings were issued, particularly about the rapid growth of leverage and the opacity of complex securities. But these warnings were general, cautious, easily dismissed by optimists pointing to strong growth and low defaults. National regulators, meanwhile, focused primarily on domestic institutions, with limited ability to see the full global picture. A German regulator might notice that German banks held unusual amounts of American mortgage securities, but might not know that French and British and Irish banks held similar positions, might not grasp that a simultaneous crisis would overwhelm coordinated response capacity. The global financial system, in other words, had evolved faster than the regulatory and institutional frameworks designed to oversee it. Innovation had outpaced governance, complexity had outpaced understanding, and the stage was set for a crisis that would respect no borders, acknowledge no boundaries, stop at no ocean. Every bubble eventually meets its moment of truth, the point where prices can't rise anymore, where the last buyer has bought, where reality begins to reassert itself. For the American housing bubble, that moment began quietly in late 2005 and early 2006. Home prices, which had risen relentlessly for years, began to flatten. In some markets, they started to decline slightly. These declines were small initially, just a few percentage points, easy to dismiss as temporary corrections or normal market fluctuations. But they were enough to break the psychology that had sustained the bubble. Homeowners who'd planned to refinance found their homes were worth less than expected, or at least not more than they owed. The equity they had counted on hadn't materialized. Speculators who had bought properties intending to flip them couldn't find buyers at profitable prices. Houses sat on the market longer. Inventory began to accumulate. For borrowers with adjustable rate mortgages, the moment of truth arrived when their low introductory rates reset to higher rates. A family that had been paying $1,500 a month might suddenly face a payment of $2,500 or $3,000. For many, this was simply unaffordable. They had qualified based on the initial payment, but the reset payment exceeded their income's capacity. Default rates began to rise, slowly at first, barely noticeable in aggregate statistics, but real enough for the families losing their homes. A default would lead to foreclosure, which would lead to another house on the market, more inventory, more downward pressure on prices, which would lead to more defaults in a reinforcing cycle. The subprime sector felt the pressure first and most acutely. These were the riskiest loans, the borrowers with the least financial cushion, the mortgages most likely to default when circumstances tightened. By late 2006, subprime default rates had doubled from their lows of a few years earlier. By early 2007, they had doubled again. Lenders who specialized in subprime mortgages began to experience serious problems. In February 2007, HSBC, one of the world's largest banks, announced significant losses on its American mortgage portfolio. In March, New Century Financial, one of the largest subprime lenders, filed for bankruptcy. Over the course of 2007, dozens of mortgage lenders would fail or shut down operations. these failures might have been contained if the mortgages had stayed with the originating lenders. But remember, the mortgages had been securitized, sold into mortgage-backed securities and CDOs, and distributed to investors globally. The defaults weren't isolated. They were embedded in securities sitting on balance sheets around the world. Hedge funds that specialized in mortgage-backed securities began to suffer. In June 2007, two Bear Stearns hedge funds that held large positions in subprime securities collapsed, losing nearly all their investors' money. This was significant not just for the losses but for what it revealed. These securities, which had been rated safe, which had been valued using sophisticated models, were turning out to be worth far less than believed. The credit rating agencies, which had blessed these securities with AAA ratings, began downgrading them. A downgrade triggers consequences. Institutions that are required to hold only highly rated securities must sell downgraded ones. This selling pressure pushes prices down further, which leads to more downgrades, more forced selling, more price declines. Market observers began using a phrase that would become depressingly familiar: contagion. The problems weren't contained to subprime mortgages or to mortgage securities. They were spreading to other credit markets, to other types of bonds, to institutions that seemed unconnected to housing. The mechanism of contagion was primarily through liquidity and confidence. When Bear Stearns hedge funds collapsed, investors began to question other institutions. If these funds, run by smart people at a prestigious firm, could fail so dramatically, what else might be concealed? What other securities might be overvalued? What other institutions might be at risk? Banks and investors became cautious, more selective about lending. The commercial paper market, where companies and financial institutions borrow for short-term needs, began to freeze. Interest rates spiked for certain borrowers. Institutions that had relied on cheap, easy credit found themselves struggling to refinance maturing debts. In August 2007, the European Central Bank injected 95 billion euros into banking markets to ensure liquidity, an extraordinary action signalling serious stress. In September, Northern Rock, a British bank heavily exposed to mortgage lending, experienced a bank run, with depositors queuing outside branches to withdraw their savings, scenes that seemed impossible in a modern developed economy. Yet even as these cracks appeared, even as warnings multiplied, the full scale of the coming crisis remained hidden. Many analysts believed the problems were contained to subprime mortgages, that the damage would be limited, that the broader economy and financial system would weather the storm. This belief persisted well into 2008, sustained by hope, by institutional inertia, by the difficulty of imagining how bad things could truly get. As problems multiplied in late 2007 and early 2008, policymakers and financial institutions attempted to contain the damage, to prevent a limited crisis from becoming a systemic catastrophe. Understanding these efforts, and why they ultimately fell short, reveals how deeply the vulnerabilities had penetrated. The Federal Reserve, led by Chairman Ben Bernanke, began cutting interest rates aggressively. The federal funds rate, which had been over 5% in mid-2007, was slashed to 3% by early 2008 and would eventually reach near zero. Lower interest rates were meant to stimulate borrowing and spending, to support asset prices, to make it easier for troubled institutions to refinance their debts. The Fed also opened new lending facilities, creating mechanisms to provide emergency liquidity to banks and eventually to other financial institutions. These were extraordinary measures, departing from normal operations, but they reflected the Fed's growing alarm about systemic risks. the Bush administration proposed a fiscal stimulus package, sending rebate checks to millions of Americans in hopes of boosting consumer spending and supporting the economy. Congress passed this package with broad bipartisan support in early 2008. A rare moment of agreement driven by shared concern about economic deterioration. Financial institutions attempted their own rescues and restructurings. In March 2008, JP Morgan Chase agreed to acquire Bear Stearns, but only with substantial assistance from the Federal Reserve, which agreed to assume the risk on $29 billion of Bear Stearns' most toxic assets. Bear Stearns, which had survived and thrived through nearly a century of financial history, sold for a fraction of its former value, a shocking demonstration of how quickly a major institution could collapse. Banks began writing down the value of their mortgage-related assets, acknowledging losses that had been hidden or denied. Citigroup, Merrill Lynch, Morgan Stanley and others announced billions in write-downs. These weren't just numbers on financial statements. They were capital being destroyed, reducing the bank's ability to lend, forcing them to raise new capital or shrink their operations. Sovereign wealth funds from Asia and the Middle East invested billions in troubled American banks providing needed capital. This foreign investment was welcomed, even celebrated as evidence of confidence in American finance. But it also reflected the reality that American institutions couldn't generate sufficient capital internally, and that domestic investors were too wary to provide it. Regulators attempted to coordinate internationally, recognizing that the crisis knew no borders. The Federal Reserve arranged currency swap lines with other central banks, ensuring that foreign banks could access dollars when private markets seized up. These swaps would eventually total hundreds of billions of dollars, a measure of how global the crisis had become. Yet for all these efforts, the crisis continued to deepen. Each intervention seemed to buy temporary relief, a few weeks or months of relative calm, before new problems emerged. This was partly because the interventions, while significant, were incremental. Calibrated responses to what policymakers believed was contained crisis. There was genuine uncertainty about the scope of the problem. How many mortgages would default? How much were mortgage-backed securities really worth? Which institutions were solvent and which were insolvent? These weren't easy questions. The securities were complex, the markets illiquid, the models unreliable. Valuing assets that no one wanted to buy at any price was more art than science. There was also political and ideological resistance to more aggressive intervention. Government rescues of private institutions raised moral hazard concerns. If banks knew they would be bailed out, wouldn't they take excessive risks in the future? There were also fairness questions. Why should taxpayers rescue banks that had made foolish decisions? Why should executives who had earned millions in bonuses receive government assistance? These concerns were legitimate, reflecting real tensions between market discipline and financial stability. But they complicated policymaking, introducing delays and half measures at moments that might have benefited from decisive action. Moreover, the tools available to policymakers were limited by legal and political constraints. The Federal Reserve could lend to banks, but its authority to support non-bank institutions was unclear. The Treasury could propose programs but needed congressional approval for funding. Regulators could supervise institutions under their jurisdiction, but the shadow banking system operated largely beyond that jurisdiction. As summer 2008 approached, the situation remained precarious. Housing prices were still declining. Foreclosures were still rising. Financial institutions were still announcing losses. Credit markets were still frozen. The interventions had prevented complete collapse, but they hadn't restored health or confidence. And the worst was yet to come. The institutions and mechanisms that had survived the crisis so far were about to face pressures that would prove overwhelming, that would force policymakers to abandon precedent and ideology, that would bring the global financial system to the brink of outright collapse. Those pressures would arrive in September 2008 in a span of days that would define the crisis and reshape the world economy. September 12th, 2008 was a Friday, and by any measure it should have been a day of relief and preparation for the weekend. But for the people gathered at the Federal Reserve Bank of New York, it was the beginning of a weekend that would fundamentally alter the course of financial history. Lehman Brothers, one of Wall Street's oldest and most prestigious investment banks, was dying. The firm had survived the Civil War, 2 world wars, the Great Depression, and countless financial panics across more than a century and a half of American history. But it could not survive its exposure to subprime mortgages and the commercial real estate market, which was now collapsing in parallel to residential housing. Lehman's stock price had plummeted throughout the week. Counterparties, the firms that did business with Lehman, were losing confidence, refusing to trade with the bank or demanding additional collateral that Lehman couldn't provide. This is how modern financial institutions die, not through losses alone, but through the withdrawal of confidence, through the refusal of others to do business with them. Secretary of Treasury Henry Paulson, Federal Reserve Chairman Ben Bernanke, and Timothy Geithner, President of the New York Fed, gathered Wall Street's most powerful executives at the Fed building. Bank of America, J.P. Morgan Chase, Goldman Sachs, Morgan Stanley, Citigroup, the titans of American finance assembled to discuss whether they could collectively rescue Lehman, as they had rescued long-term capital management a decade earlier. The government's message was clear. No public money would be used to save Lehman. The Bear Stearns rescue had generated political backlash, accusations of socialism and cronyism. An election was approaching. Public opinion was firmly against bailouts. Private industry would need to solve this privately. Throughout Friday night and all day Saturday, teams of analysts pored over Lehman's books, trying to assess its assets and liabilities, trying to determine if a rescue was feasible. What they found was deeply troubling. Lehman's assets, particularly its commercial real estate holdings and its mortgage-backed securities, were worth far less than the bank claimed. The hole in Lehman's balance sheet was enormous, perhaps insurmountable. Bank of America, which had been considered the most likely buyer, announced on Sunday morning that it would instead acquire Merrill Lynch, another troubled investment bank. This was itself extraordinary news. Merrill Lynch, the iconic thundering herd, was being sold in an emergency weekend transaction. But it also meant Lehman had no obvious buyer. Barclays, a British bank, expressed interest but needed approval from British regulators. That approval was not forthcoming. The British government, dealing with its own financial stress, was unwilling to import American problems. As Sunday evening approached, it became clear that no private rescue would materialize. The consortium of banks couldn't or wouldn't commit the capital necessary. The government wouldn't provide public funds. Lehman Brothers would file for bankruptcy. The bankruptcy filing came late Sunday night, the largest in American history. When markets opened Monday morning, the consequences would begin to unfold in ways that surprised even the sophisticated policymakers who had allowed it to happen. They had believed that Lehman's failure had been anticipated, that markets had priced in this possibility, that counterparties had hedged their exposures. They had believed that allowing one major institution to fail would demonstrate that bailouts weren't automatic, that moral hazard mattered, that market discipline would be enforced, they were wrong on almost every count. Lehman's failure didn't demonstrate discipline. It demonstrated that no institution was safe, that government support couldn't be relied upon, that counterparty risk was real and potentially catastrophic. If Lehman could fail, maybe anyone could fail. The immediate casualty was American International Group AIG, one of the world's largest insurance companies. AIG hadn't made mortgages or created mortgage-backed securities. It had sold insurance on those securities, instruments called credit default swaps, contracts that promised to pay if the underlying securities defaulted. AIG had sold enormous quantities of these swaps, collecting premiums, believing the securities were safe. But as mortgage securities collapsed in value, as defaults multiplied, AIG owed billions to counterparties. And with Lehman's bankruptcy creating panic about counterparty risk, institutions demanded that AIG post collateral immediately. AIG didn't have sufficient liquid assets, it faced imminent collapse. Unlike Lehman, AIG's failure would be truly systemic. The company had business relationships with hundreds of institutions globally. Its collapse would trigger cascading failures across the financial system. On Tuesday, September 16th, just one day after Lehman's bankruptcy, the Federal Reserve announced an $85 billion loan to AIG, essentially nationalizing the company. The contrast was stark and disturbing. Lehman was allowed to fail on Sunday. AIG was rescued on Tuesday. What was the principle? What was the rule? The answer seemed to be that there was no rule, that decisions were being made in crisis mode, that policymakers themselves didn't know where the lines were. This uncertainty was itself toxic, perhaps more damaging than either failure or rescue would have been individually. Markets can adapt to almost any reality, but they struggle with radical uncertainty about what the authorities will do. In the days following Lehman's bankruptcy and AIG's rescue, something unprecedented happened across global financial markets. They essentially froze, not metaphorically but functionally. Markets that had operated smoothly for decades suddenly ceased functioning. The commercial paper market, where companies borrow for short-term needs like payroll and inventory, seized up. Interest rates spiked to levels that made borrowing prohibitively expensive when borrowing was possible at all. Money market funds, which had always maintained a stable $1 share price, began to sect, quote 7, falling below $1 as the value of their holdings declined. This created panic among ordinary Americans who had thought their money market accounts were essentially like bank accounts, safe and liquid. They began withdrawing funds en masse, generating a run on money market funds that threatened to collapse a $3 trillion market. The LIBOR OES spread, a technical measure that indicates how much banks trust each other, exploded to unprecedented levels. Banks were refusing to lend to each other, even overnight, even for secured loans backed by collateral. The basic plumbing of the financial system, the mechanisms through which money flows from lenders to borrowers, the confidence that allows institutions to do business with each other, had broken down. Internationally, the panic spread with terrifying speed. European banks, which had significant exposure to American subprime securities and to Lehman Brothers as a counterparty, saw their stock prices collapse. Iceland, a small nation whose banks had expanded aggressively during the bubble, faced complete financial system collapse, eventually requiring an IMF bailout. The TED spread, another technical measure comparing the interest rate on interbank loans to the rate on Treasury bills, hit levels not seen since the 1987 stock crash. This spread measures fear in the financial system, the premium banks' demand for lending to each other versus lending to the US government. The wider the spread, the more fear. In September 2008, that fear was extreme. Currency markets experienced violent swings. The dollar surged as investors fled to safety, then plummeted on fears about American economic collapse, then surged again. Emerging market currencies, particularly in Eastern Europe and Latin America, fell sharply as global investors withdrew capital, seeking safety in developed markets. Commodity prices, which had been rising steadily for years, reversed course. Oil, which had reached nearly $150 per barrel in July, fell to below $50 by December. Copper, wheat, corn, prices collapsed across the board as markets anticipated global recession and declining demand. Stock markets around the world experienced their worst performance since the 1930s. The Dow Jones Industrial Average, which had been above 14,000 in 2007, fell to below 7,000 by early 2009, a decline of more than 50%. European and Asian markets experienced similar or worse declines, but perhaps most disturbing was what was happening in credit markets that ordinary people rarely think about, but that are essential to economic functioning. Asset-backed securities markets, where loans for automobiles, credit cards, and student education are bundled and sold, froze. Auto loans became difficult to obtain, credit card limits were slashed, students couldn't get loans for education. Corporate bond markets, where companies raise capital for expansion and operations, virtually shut down. Companies that needed to refinance maturing debt found no buyers. Investment-grade corporations, companies with strong credit ratings, couldn't issue bonds except at punitive interest rates. The lockup in these markets meant that the financial crisis was rapidly becoming an economic crisis. Companies couldn't borrow for ordinary operations. They began laying off workers, cutting investment, hoarding cash. Consumer confidence collapsed as people watched their retirement savings evaporate and their home values plummet. It's difficult to convey the sense of fear that pervaded these days. People who had worked in finance for decades, who had experienced the 1987 crash and the dot-com bust and various emerging market crises, said they had never seen anything like this. The normal mechanisms of markets, price discovery, liquidity, arbitrage, confidence, had broken down. The machinery of finance had seized up, and no one knew exactly how to fix it. Policymakers were improvising, trying interventions that had never been attempted before, using authorities that existed in dusty sections of old laws, creating facilities and programs on the fly. The Federal Reserve began buying commercial paper directly, something it had never done. The Treasury guaranteed money market funds, an extraordinary step to prevent their complete collapse. But these measures, while necessary, weren't sufficient to restore confidence or liquidity. The crisis had moved beyond the financial sector, beyond housing markets and mortgage securities, into the real economy where ordinary people lived and worked. And that's where we must turn our attention next, to understand how a financial crisis became an economic catastrophe. While the previous chapters have focused on banks and markets and securities, we need to remember that these aren't abstractions. They're mechanisms that connect to real lives, real families, real communities. And as the financial crisis deepened in late 2008, those connections became painfully clear. Unemployment, which had been relatively low at around 5% in early 2008, began to rise sharply. By the end of 2008, it had reached 7%. It would eventually peak at 10% in late 2009, representing about 15 million Americans out of work. These aren't just statistics. Each percentage point represents over 1 million people who lost their jobs, their incomes, their sense of security. The job losses were concentrated initially in construction and finance, the sectors most directly connected to the housing bubble. Construction workers who'd been framing houses in booming suburbs found themselves unemployed as new home construction collapsed. Real estate agents who'd earned comfortable living selling homes found their income evaporating. Mortgage brokers, appraisers, title insurers, all the professions that had flourished during the boom contracted sharply. But the losses spread quickly to manufacturing, retail, services, essentially every sector of the economy. Companies facing credit market freezes, anticipating recession, watching their customers pull back, responded by cutting costs, which primarily meant cutting workers. For families living paycheck to paycheck, job loss meant immediate crisis. Mortgages went unpaid, leading to foreclosure. Rent checks bounced, leading to eviction. Credit card payments were missed, leading to spiraling debt. Healthcare became unaffordable without employer-provided insurance. College savings evaporated, forcing students to drop out or take on more debt. Foreclosures, which had been rising since 2006, accelerated dramatically. In 2008, over 2 million American homes entered foreclosure. In 2009 and 2010, foreclosures would exceed 2 million annually again. Over the course of the crisis, roughly 6 million American families would lose their homes to foreclosure. Think about what foreclosure means in human terms. It's not just losing a financial asset. It's losing the place where you raised your children, where you celebrated holidays, where you built memories. It's the shame of admitting failure, the stress of packing and leaving, the trauma of starting over. For children, it often meant changing schools, leaving friends, experiencing instability at formative moments. Neighborhoods that had boomed during the bubble became landscapes of decline. In cities like Las Vegas, Phoenix, and parts of Florida and California, entire subdivisions stood partially empty, with every third or fourth house vacant, lawn unmowed. Foreclosure notice on the door. These vacancies depressed surrounding property values, creating negative equity for neighbors who are still making payments. Negative equity, or being trapped millions of families. If you bought a house for $300,000 with a 10% down payment, you owed $270,000. If that house's value fell to $200,000, you owed more than the house was worth. You couldn't sell without bringing cash to closing. You couldn't refinance into a better mortgage. You were stuck paying a mortgage on an asset worth less than your debt. Retirement savings, invested in stock markets through 401k accounts and IRAs, suffered devastating losses. People in their 50s and 60s, approaching retirement, watched accounts they had built over decades lose 40 or 50% of their value. Retirement plans were postponed. Some people who had already retired were forced to return to work. Consumer spending, which represents about 70% of American economic activity, collapsed. People who still had jobs became cautious, worried about keeping them, aware that neighbors and friends were being laid off. They delayed purchases, built up savings when possible, cut back on anything discretionary. This caution was individually rational but collectively destructive, as one person's spending is another person's income. Small businesses, which employ about half of all American workers, struggled particularly hard. They typically have less access to credit than large corporations, operate with smaller cash reserves, depend more directly on local economic conditions. When banks stopped lending, when customers stopped spending, small businesses failed in enormous numbers. The crisis also exposed and exacerbated existing inequalities. Minority communities, which had been targeted by subprime lenders during the boom, experienced disproportionately high foreclosure rates during the bust. Wealth gaps between white and minority households, between educated and less educated workers, between young and old, all widened. There were also psychological and social costs that don't appear in economic statistics. Depression rates increased, suicide rates rose, divorce rates climbed as financial stress fractured relationships, domestic violence increased, drug and alcohol abuse worsened. The crisis didn't just destroy wealth, it damaged mental health, social cohesion, and human dignity. As the economic pain spread from Wall Street to Main Street, as unemployment rose and foreclosures multiplied, policymakers faced enormous pressure to act more decisively, to move beyond the incremental measures that had failed to stop the crisis. The most dramatic intervention came in October 2008 with the Troubled Asset Relief Program, or TARP. Treasury Secretary Henry Paulson and Federal Reserve Chairman Ben Bernanke went to Congress asking for $700 billion in taxpayer money to stabilize the financial system. This was an extraordinary request, a sum that would increase the national debt by a significant percentage, a direct government intervention in markets on a scale not seen since the Great Depression. The initial plan was to buy troubled mortgage-backed securities from banks, to remove toxic assets from their balance sheets and restore confidence. But this plan faced immediate criticism. How would the government value these securities? If they paid too much, they would be subsidizing banks at taxpayer expense. If they paid too little, banks wouldn't sell and the program would fail. Moreover, congressional reaction was fierce. The initial vote on TARP failed in the House of Representatives, with politicians of both parties skeptical about using taxpayer money to rescue banks, while ordinary Americans were losing homes and jobs. The stock market fell nearly 800 points that day, the largest point drop in history at the time, demonstrating what markets thought of congressional inaction. Congress eventually passed a revised version of TARP, but the program's implementation changed significantly from the original plan. Instead of buying toxic assets, the Treasury decided to inject capital directly into banks, taking ownership stakes in exchange for cash. This was faster, simpler, and arguably more effective than the original asset purchase plan. The largest banks, Citigroup, Bank of America, JP Morgan Chase, Wells Fargo, Goldman Sachs, Morgan Stanley, and others, were essentially forced to accept government capital, even if they claimed they didn't need it. The idea was to avoid stigma. If only the weakest banks accepted government money, that acceptance would signal weakness and potentially trigger runs. If everyone took money, no one could be singled out. This capital injection helped stabilize the banking system, but it was politically toxic. Images of bank executives continuing to receive large bonuses while their institutions survived on taxpayer support generated public fury. The phrase "quote 9" entered popular consciousness, describing institutions so large and interconnected that their failure would cause systemic collapse, and which therefore must be rescued regardless of their behavior. The Federal Reserve, meanwhile, was pushing the boundaries of its traditional role. Interest rates had already been cut to near zero, leaving little room for conventional monetary policy. So the Fed began quantitative easing, purchasing huge quantities of treasury bonds and mortgage-backed securities, injecting trillions of dollars into the financial system. The theory was that by buying these securities, the Fed would lower interest rates across the economy, making borrowing cheaper, encouraging spending and investment. Supporting asset prices. This was unprecedented in scale and scope, transforming the Fed's balance sheet from under $1 trillion before the crisis to over $4 trillion at its peak. The Fed also created numerous emergency lending facilities with intimidating acronyms: TALF, CPFF, AMLF, PDCF. Each facility was designed to address a specific dysfunction in credit markets, one for asset-backed securities, one for commercial paper, one for money market funds, one for primary dealers. The Fed was essentially becoming lender of last resort not just to banks, but to the entire shadow banking system. Internationally coordinated action was emerging. In October 2008, central banks around the world cut interest rates simultaneously, a coordinated move designed to signal unity and determination. Governments announced stimulus packages, infrastructure spending, tax cuts, unemployment benefits, meant to support demand as private spending collapsed. The G20, representing the world's largest economies, met to coordinate responses and to commit to avoiding the protectionist policies that had worsened the Great Depression. This commitment was important, as there were pressures in many countries to protect domestic industries, to restrict trade, to turn inward. Yet despite these massive interventions, the economy continued to deteriorate through the end of 2008 and into 2009. The measures prevented complete collapse, but they didn't quickly restore health. Credit remained tight, unemployment kept rising, foreclosures continued mounting. The crisis had too much momentum, too much damage already done, too many negative feedback loops already in motion. President-elect Barack Obama, who would take office in January 2009, faced the daunting task of governing amid the worst economic crisis in 80 years, with a financial system still fragile, with millions of Americans suffering, with no clear template for how to fix everything that had broken. The acute phase of the crisis, the panic, the bank failures, the market freeze, lasted roughly from September 2008 through March 2009. But recovery from the crisis would take many years, and in some ways the effects persist to this day. The American Recovery and Reinvestment Act, signed by President Obama in February 2009, injected nearly $800 billion into the economy through tax cuts, unemployment benefits, infrastructure spending, and aid to states. This was the largest fiscal stimulus in American history, designed to replace the private demand that had collapsed, to prevent the recession from becoming a depression. Economists still debate whether the stimulus was too small, too large, or properly sized. The economy did begin growing again in the second half of 2009, technically ending the recession. But the recovery was painfully slow. GDP growth was anemic compared to recoveries from past recessions. Unemployment remained elevated for years, not returning to pre-crisis levels until 2016. The housing market stabilized eventually, but not quickly. Home prices continued falling until 2012, representing a roughly 35% decline from peak to trough nationally, with much larger declines in the hardest-hit markets. The foreclosure crisis extended well into the 2010s, with millions of families still losing homes years after the acute financial crisis had ended. For financial institutions, the recovery path was complicated. Most of the large banks that had received TARP funds repaid those funds relatively quickly, by 2010 or 2011, and actually generated a profit for taxpayers. But AIG, which had required multiple bailouts totaling over $180 billion, took much longer to repay. The final AIG shares held by the Treasury weren't sold until 2012, regulatory reform became a major focus. The Dodd-Frank Wall Street Reform and Consumer Protection Act, passed in 2010, represented the most significant overhaul of financial regulation since the Great Depression. It created new regulatory structures, imposed higher capital requirements on banks, restricted certain risky activities, and established the Consumer Financial Protection Bureau to oversee consumer lending. Banks were required to hold more capital, to maintain larger cushions against losses. The largest banks designated as systemically important faced even stricter requirements and more intensive supervision. The goal was to make the system more resilient, to reduce the likelihood of future crises, to ensure that if crises did occur, they could be managed without taxpayer bailouts. The Volcker Rule, a component of Dodd-Frank, restricted banks from engaging in proprietary trading, from betting their own capital on market movements. This was meant to separate traditional banking, taking deposits, making loans, from riskier trading activities. Stress tests became a regular feature of bank supervision, with regulators periodically examining whether major banks could survive severe economic scenarios. These tests, and the public disclosure of their results, were meant to reassure markets about banks' strength and to identify weaknesses before they became crises. Internationally, the Basel III framework imposed similar requirements on banks globally, creating more consistency in regulation across borders. The Financial Stability Board, an international body, began coordinating macroprudential oversight, attempting to monitor system-wide risks rather than just individual institutions. Yet regulatory reform was controversial and remains contested. Critics argue that Dodd-Frank imposed excessive costs on banks, reducing lending and harming economic growth. Defenders argue that the regulations were necessary and even insufficient, that the financial system remains too complex, too interconnected, too risky. The crisis also prompted soul-searching about economic inequality and the distribution of its costs. Bankers and executives who had contributed to the crisis rarely faced personal consequences. Very few criminal prosecutions occurred, leading to perceptions that there were different justice systems for Wall Street and Main Street. Meanwhile, ordinary families lost homes, jobs, savings, and faced years of hardship. This perceived unfairness contributed to political movements on both the left and right, to the Occupy Wall Street protests and the Tea Party movement, to broader questions about capitalism, inequality, and the role of government. The political landscape was reshaped by the crisis, with trust in institutions declining, populism rising, and traditional political coalitions fracturing. Globally, the crisis had lasting effects on Europe, where sovereign debt crises in Greece, Ireland, Portugal, Spain, and Italy created secondary crises that extended the pain. The European Union structure, particularly the euro currency used by countries with very different economic situations, proved ill-equipped to handle the crisis, leading to years of austerity, high unemployment, and political tension. For individuals, recovery was highly uneven. Those who kept their jobs through the crisis, who didn't lose homes to foreclosure, who didn't need to sell stocks at market bottoms, generally recovered reasonably well as markets eventually rebounded. But those who lost jobs faced years of unemployment or underemployment. Those who lost homes faced damaged credit and difficulty buying again. Those who retired or sold assets at the wrong moment faced permanent losses. The crisis revealed and in many cases worsened economic inequality. Stock market recovery benefited those who owned stocks, primarily wealthier households. Housing market recovery was slower and didn't benefit those who had lost homes. Wage growth remained weak for years, while corporate profits recovered strongly. Perhaps most significantly, the crisis changed how an entire generation thinks about risk, debt, home ownership, and finance. Millennials who entered the job market during the crisis faced limited opportunities, lower wages, and higher student debt burdens. Their attitudes toward home ownership, toward financial institutions, toward capitalism itself were shaped by witnessing the crisis and its aftermath. Now that we've traced the crisis from its origins through its acute phase and into recovery, we can step back and contemplate a more philosophical question. What fundamentally caused this crisis? Was it simply greed, as the title of our documentary suggests, or was something more complex at work? Greed certainly played a role. Mortgage brokers earned higher commissions for riskier loans and had incentives to approve applications regardless of borrowers' actual ability to repay. Investment bankers earned enormous bonuses for creating and selling complex securities without bearing the long-term risks of those securities. Rating agencies were paid by the institutions whose securities they rated, creating obvious conflicts of interest. Executives structured their compensation to reward short-term profits over long-term stability. These incentives rewarded behavior that benefited individuals while creating systemic risks. Someone approving a fraudulent mortgage application, someone creating a CDO filled with toxic securities, someone giving an unjustified AAA rating. These actions might generate immediate personal profit while contributing to eventual collective disaster. But reducing the crisis to simple greed overlooks important dimensions. Many participants genuinely believed they were doing the right thing, that they were expanding home ownership, that they were innovating in finance, that they were properly pricing risk. The mathematical models used to rate securities and manage risk were created by smart people with advanced degrees, people who believed in the soundness of their work. There was also a collective delusion, a sincere belief that housing prices would continue rising, or at least wouldn't fall significantly, that diversification and securitization had genuinely distributed and reduced risk, that we had entered a new era of more stable, more sophisticated finance. Fed Chairman Alan Greenspan, testifying before Congress after the crisis, admitted to being shocked that self-interest didn't lead institutions to protect themselves better, that his ideology had been fundamentally challenged. Behavioral economics offers some insights here. Humans are subject to systematic biases that lead to poor decisions even when we're trying to act rationally. Recency bias makes us weight recent experience too heavily. When housing prices had risen for years, we expected them to keep rising. Confirmation bias makes us seek information that confirms our beliefs. When we wanted to believe the boom was sustainable, we dismissed warnings and focused on reassuring data. Herding behavior is powerful in finance. When everyone else is buying mortgage securities, when everyone else is approving risky loans, when everyone else is leveraging their balance sheets, going against the crowd feels dangerous, feels like missing out on profits, feels like career suicide. Individual caution is punished when collective exuberance is rewarded. There's also the concept of moral hazard. The idea that protection from consequences encourages risky behavior. If banks believed they were too big to fail, if they expected government rescues in crises, they had less incentive to avoid excessive risk. This belief turned out to be partially correct. The largest banks were rescued, which raises difficult questions about how to encourage prudence when the downside of failure is socialized while the upside of success is privatized. Complexity itself was a factor. The financial instruments that were created, CDOS, synthetic CDOS, credit default swaps, were genuinely complex, difficult to understand even for sophisticated investors. This complexity made it easier to hide risk, to engage in wishful thinking about valuations, to believe that models were capturing reality when they were actually missing crucial dynamics. Regulation, or the lack thereof, certainly contributed. The shadow banking system operated with little oversight. The mortgage market was inadequately supervised. Derivatives markets were essentially unregulated. These regulatory gaps existed partly due to ideology, a belief that markets were self-correcting, and partly due to the political power of the financial industry, which lobbied against regulation. But regulatory failure also reflected genuine difficulty. Financial innovation outpaced regulatory capacity. Global capital flows made purely national regulation less effective. Regulators faced limitations in authority, resources, and political support. Even when regulators identified risks, they often lacked tools or political backing to address them forcefully. There's a question of collective responsibility too. Borrowers who took out mortgages they couldn't afford, who lied on applications, who speculated in housing, bear some responsibility for their choices. But many borrowers were misled, were sold products they didn't understand, were assured by professionals that these mortgages were appropriate. The asymmetry of information and sophistication between borrowers and lenders matters for assessing moral culpability. Perhaps the most honest answer is that the crisis resulted from the interaction of many factors: individual greed and collective delusion, flawed incentives and behavioral biases, regulatory gaps and ideological blindness. Complexity and interconnection, moral hazard and speculation. No single villain caused it. No single fix could have prevented it. It was systemically complex, emerging from the structure and dynamics of modern finance and housing markets. This complexity makes the crisis harder to understand, but also more important to study. If we could simply blame evil bankers, we could fire them and move on. But if the crisis emerged from incentive structures, from regulatory frameworks, from collective beliefs and behaviors, then preventing future crises requires deeper, more sustained changes to how finance operates and is governed. We've discussed foreclosures and unemployment in statistical terms, but numbers can obscure human realities. Let's consider more carefully what the crisis meant for ordinary people, for families trying to live their lives. Imagine you're a family in suburban Phoenix in 2006. You bought a house in 2004 for $300,000. You make a combined income of $70,000 a year. Your mortgage broker assured you that an option arm was a smart choice, that the low initial payments would allow you to afford a nicer house, that you could refinance before the rate adjusted. Everything seemed fine for 2 years. Then your rate adjusts. Your payment doubles from $1,500 a month to $3,000. You can't afford this. You try to refinance, but your house, which was briefly worth $400,000, is now worth only $250,000. You owe more than it's worth. No one will refinance an underwater mortgage. You're trapped. You try to keep up with payments by cutting everything else. No vacations, no restaurants, no new clothes for the kids. You put expenses on credit cards hoping to buy time, but then one of you loses your job. The construction industry has collapsed and employers are laying off. Suddenly you have no chance of making the mortgage payment. You call your bank asking for help. They tell you to apply for a loan modification. You submit paperwork. Weeks pass. Then months. You call repeatedly. You're told different things by different representatives. The process is confusing, bureaucratic, seemingly designed to frustrate. Meanwhile, you're falling behind on payments. The bank sends foreclosure notices. You consult a lawyer but can't afford to hire one. You consider bankruptcy, but that has its own costs and complications. Your credit score, which you worked years to build, is destroyed. Eventually, inevitably, you lose the house. You pack up your family's possessions. You tell your children they'll be moving, changing schools, leaving their friends. You try to explain what happened in ways they can understand, knowing they sense your stress and fear even if they don't grasp the details. You move into a rental apartment, smaller than your house, in a different school district. Your kids struggle with the transition. Your marriage is strained by financial stress and the loss of the home you built together. You're angry at the bank, at the broker who sold you the mortgage, at yourself for believing them, at a system that seems to have failed you. Or imagine you're in your early 60s planning to retire in a few years. You've saved diligently, invested primarily in stock mutual funds through your 401k. You watched your account grow from $100,000 to $300,000 over 20 years. That money represents security, the retirement you promised yourself, freedom from work. Then the crisis hits. Over 6 months, your account loses half its value. What was $300,000 is now $150,000. You're devastated, angry, frightened. Retirement is impossible now. You'll need to work years longer than you planned, assuming you can keep your job as your company announces layoffs. You wonder if you should sell, should get out of the market before losing more. Financial advisors say to stay invested, that selling locks in losses, that markets will recover. But how can you be sure? You've lost trust in the advice that got you here. You keep working. Your body is aging, your energy declining. Jobs that once felt routine now feel exhausting. Younger colleagues are being promoted past you. You feel stuck, betrayed by a system that told you to save and invest, that promised retirement security if you played by the rules. Or perhaps you're a recent college graduate in 2009, holding a degree and $50,000 in student loan debt. You expected to find a job in your field, to start your career, to begin building adult life. Instead, you send out hundreds of applications and receive very few responses. Companies aren't hiring. The economy is contracting. You move back in with your parents, a humiliating regression after the independence of college. Your student loans enter repayment. You take a job in retail, earning minimum wage, well below what your degree was supposed to command. You feel like you've done everything society told you to do. Study hard, go to college, get a degree, and it hasn't worked out. Your friends are in similar situations. The future you imagined, good job, own apartment, starting a family, buying a home, seems impossibly distant. You're resentful, cynical about institutions and promises that proved hollow. This experience will shape your economic and political views for decades. These stories, multiplied across millions of families, represent the human cost of the crisis. Behind the statistics of foreclosures and unemployment are people experiencing real suffering. Stress, shame, fear, disrupted lives, damaged relationships, lost opportunities, diminished futures. The crisis also exposed class divisions in how pain was distributed. Wealthy individuals who lost money in the stock market mostly recovered as markets rebounded. They had resources to weather the storm, to avoid selling at the bottom, to wait for recovery. Working-class families who lost jobs or homes often faced permanent setbacks, couldn't wait for recovery, suffered lasting damage. Communities were torn apart, particularly minority and working-class communities that had been targeted by predatory lenders. Neighborhoods with high foreclosure rates experienced declining property values, increased crime, reduced tax revenue. Failing schools. The social fabric was damaged in ways that persist years later. There's also the psychological toll, the stress of uncertainty, the shame of failure, the fear for children's future. Mental health problems increased. Substance abuse rose. Family stability declined. These costs don't appear in economic statistics, but they're real. They matter. They represent human suffering that we must acknowledge when we assess what the crisis meant. While much of our story is focused on America, where the crisis originated, we should understand how it spread globally and the particular ways it affected different countries and regions. Iceland, a small island nation with only 300,000 people, experienced perhaps the most dramatic national crisis. Icelandic banks had expanded aggressively during the boom years, growing to hold assets worth 10 times Iceland's GDP. When the crisis hit, these banks collapsed spectacularly, wiping out much of the nation's wealth, requiring international bailouts, generating political upheaval that saw the government fall and protesters demanding accountability. For Icelanders, the crisis meant currency collapse, capital controls, frozen deposits, shattered retirement savings, and years of austerity. The country's entire economic model, which had shifted from fishing toward finance, proved unsustainable. Recovery took years and required fundamental restructuring. Ireland experienced its own severe crisis, though through a different mechanism. Irish banks had lent aggressively for property development during a massive real estate bubble. When that bubble burst, the banks faced enormous losses. The Irish government controversially guaranteed all bank debts, effectively socialising private banking losses and transferring them to taxpayers. This guarantee eventually required international bailouts, imposed brutal austerity measures, and created a lost decade for Irish workers who saw unemployment surge and wages fall while paying through taxes for bank failures. The political system was transformed as voters rejected parties that had governed for generations. Spain and Greece faced similar dynamics, with property bubbles, banking crises, and sovereign debt problems creating extended recessions. Youth unemployment in these countries reached catastrophic levels, exceeding 50% in some periods, essentially sacrificing a generation's economic prospects. The European sovereign debt crisis that emerged from 2010 onward was in many ways a secondary crisis triggered by the financial crisis. European countries that had borrowed heavily, particularly those on the periphery like Greece, Portugal and Spain, faced market doubts about their ability to repay. This created a vicious cycle where rising interest rates made debt less sustainable, which increased doubts, which raised rates further. The euro currency, shared across very different economies, made adjustment difficult. Countries like Greece couldn't devalue their currency to restore competitiveness. They could only adjust through wage cuts and austerity, which was economically painful and politically explosive. The European Union and the European Central Bank struggled to respond effectively, constrained by internal disagreements, by German insistence on fiscal discipline, by the lack of true fiscal union to complement monetary union. The response was slow, grudging, and insufficient to prevent years of unnecessary suffering. Eastern European countries, many of which had borrowed in foreign currencies, saw their debt burdens explode as their currencies depreciated. Households in Hungary or Poland who had taken out mortgages in Swiss francs or euros found their monthly payments soaring, creating widespread distress. In Asia, the impact was primarily through trade channels rather than direct financial exposure. As American and European consumers cut spending, demand for Asian exports collapsed. Manufacturing contracted sharply. Countries like China responded with massive stimulus programs, investing in infrastructure to maintain growth, but this created its own problems of excess capacity and debt accumulation. Emerging markets more broadly experienced capital flight as investors sought safety in developed markets, particularly US Treasury bonds. Currencies depreciated, making imported goods more expensive, reducing living standards. Countries with current account deficits or significant foreign debt face particularly severe pressure. For developing countries, the crisis meant reduced aid, reduced remittances from workers abroad, reduced commodity prices for exporters, reduced access to credit. The poor in these countries, already vulnerable, faced increased hunger and hardship as food prices spiked and incomes fell. International institutions like the International Monetary Fund and the World Bank had to mobilize resources to support countries in crisis, providing loans and technical assistance. But these loans often came with conditions, austerity measures, structural reforms that imposed additional pain on populations already suffering. The crisis also revealed the interdependence of global finance in ways that hadn't been fully appreciated. European banks held American subprime securities. American banks had exposures to European sovereign debt. Asian banks had lent to European banks. The web of interconnections meant that crisis anywhere could spread everywhere. This interdependence raises difficult questions about governance. No single country can regulate global finance effectively, but coordinating internationally is difficult, with different countries having different priorities, different political systems, different regulatory philosophies. The crisis demonstrated the need for global coordination, but also the difficulty of achieving it. Looking back, the global nature of the crisis seems almost inevitable, given how integrated financial markets had become. Capital could flow across borders instantly. Banks operated globally. Securities were sold worldwide. When confidence collapsed, it collapsed everywhere. When credit markets froze, they froze globally. When recession came, it came to most of the world simultaneously. More than a decade after the acute phase of the crisis, we can ask what lessons were learned, what changes were made, and crucially, what vulnerabilities might remain or have emerged anew. Some lessons seem to have been learned. Banks are required to hold more capital now than before the crisis. Capital requirements are higher, particularly for the largest and most systemically important institutions. This means banks have larger cushions to absorb losses, making them more resilient to shocks. Stress testing has become routine, forcing banks to demonstrate they could survive severe economic scenarios. Liquidity requirements have been tightened. Banks must maintain sufficient liquid assets to survive periods when market funding dries up. The reliance on short-term funding that proved so dangerous in 2008 has been reduced, at least for traditional banks. The shadow banking system, while still large, has been brought more into regulatory purview. Money market funds were reformed to reduce run risk. Derivatives trading was pushed onto exchanges where possible, increasing transparency. Securitization practices were improved with requirements that originators retain some risk. Resolution planning, or just quote Dohen, requires large banks to demonstrate how they could be wound down in failure without triggering systemic crisis. The goal is to make too big to fail institutions actually resolvable, to create mechanisms for failure that don't require taxpayer bailouts. Consumer protection improved with the creation of the Consumer Financial Protection Bureau, which has authority to regulate mortgage lending, credit cards, and other consumer financial products. Mortgage lending standards tighten significantly, with requirements to verify borrowers' ability to repay. Internationally, coordination has improved through the Financial Stability Board and Basel III, creating more consistent regulation across borders. Central banks have maintained closer communication and cooperation, having learned from the crisis the importance of coordinated action. These reforms aren't trivial. They represent genuine efforts to address weaknesses that the crisis exposed. Banks are safer, more resilient, better capitalized than they were in 2008. The probability of a similar crisis emerging through similar channels has been reduced, yet significant vulnerabilities remain or have emerged. The financial system continues to be complex and interconnected, with channels for contagion that aren't fully understood. The growth of passive investing, of algorithmic trading, of new types of financial institutions raises questions about stability in stressed conditions. Corporate debt has grown substantially, particularly lower quality debt. Many companies are more leveraged now than before the crisis, which could create problems if revenues decline in a recession. The covenant-light loan market, where borrowers have fewer restrictions and protections are weaker, has expanded dramatically. Asset prices in many markets have reached levels that some analysts consider elevated or even bubbly, sustained by low interest rates. Stock valuations by many metrics are high. Commercial real estate in some cities appears overpriced. If a trigger causes these prices to fall sharply, wealth effects and financial stress could follow. The explosion of private equity and private credit, operating somewhat outside traditional banking regulation, represents a new form of shadow banking. These institutions manage trillions of dollars, using leverage, engaging in complex transactions, but with less transparency and regulatory oversight than banks. Climate change poses financial stability risks that the previous crisis didn't involve. Extreme weather events can create sudden losses. The transition to clean energy will strand some assets. Physical and transition risks aren't yet fully priced into markets or adequately incorporated into regulatory frameworks. Politically and socially, the lessons are more ambiguous. Public anger at bank bailouts was intense, but financial industry political influence remained strong. Regulation has been partially rolled back under different administrations. The consensus that produced Dodd-Frank has fractured, with ongoing debates about whether regulation is too strict or too loose. Inequality has worsened since the crisis, with wealth concentration increasing. The perception that elites faced no consequences while ordinary people suffered has fueled populism and political instability. Trust in institutions has declined. This social and political fragmentation makes coordinated crisis response more difficult. There's also a risk of complacency. As time passes, memories fade. A new generation of financiers has entered the industry without direct experience of the crisis. Risk appetites return. Practices that proved dangerous can re-emerge under new names and forms. The moral hazard problem persists. If market participants believe that central banks will always intervene to prevent crises, that governments will always bail out systemically important institutions, they have reduced incentive to avoid risk. The implicit guarantee of rescue can encourage the very risk-taking that makes rescue necessary. Perhaps most concerning, we haven't solved the fundamental tension between financial stability and innovation, between allowing markets to discipline failure and protecting the system from catastrophic collapse, between financial sector profitability and public interest. These are deep structural questions without easy answers. They require balancing competing values, efficiency versus stability, innovation versus safety, market freedom versus regulatory control. Different societies and political systems will answer these questions differently, and the answers may change over time. What we can say with confidence is that another financial crisis will eventually occur. The specific form will differ from 2008, emerging from different vulnerabilities through different channels. But the basic dynamics, excessive leverage, asset price bubbles, interconnection, panic, contagion, are likely to appear again in some form. The question isn't whether another crisis will happen, but whether we'll be better prepared when it does, whether the reforms and lessons of the last crisis have made the system more resilient, whether policymakers will act more swiftly and effectively, whether the human cost will be reduced. As we approach the end of our exploration, let's contemplate some deeper questions about what the crisis reveals about modern finance, about capitalism, about the economic systems we've constructed. Finance, at its core, is supposed to serve a social purpose, to channel savings to productive investment, to help people manage risk and smooth consumption over time, to facilitate transactions and trade. A bank that lends to a small business is supporting job creation and economic activity. A mortgage that helps a family buy a home is facilitating the formation of households and communities. Insurance that protects against losses allows people to take risks they otherwise couldn't. But finance has also become, especially in recent decades, somewhat disconnected from these real economic functions, operating increasingly as an end in itself. The majority of financial transactions involve trading existing assets rather than funding new investment. Traders profit from millisecond advantages in information or execution, extracting value from other traders without creating anything new. The 2008 crisis revealed this disconnect starkly. The mortgage securities and CDOs that nearly destroyed the financial system weren't funding new housing or productive investment. They were repackaging existing mortgages, trading claims on those mortgages, betting on the performance of those mortgages. This activity generated enormous profits for those involved, but didn't create proportional social value. There's a question of scale, too. The financial sector has grown dramatically as a share of the economy. In the United States, finance represented about 4% of GDP in the 1980s, but had grown to about 8% by the 2000s. Financial sector profits represented an even larger share of corporate profits, reaching 40% at times. Is this growth productive? Are we better off with finance being this large a part of our economy? Some of this growth reflects genuine innovation and value creation, better risk management, more efficient capital allocation, increased access to credit. But some may reflect rent extraction, profits that come from market power or information asymmetries rather than value creation. The crisis also raises questions about the distribution of rewards and risks. Financial sector employees, particularly at senior levels, earned extraordinary compensation in the years leading up to the crisis. This compensation was justified by the profits their institutions generated. But when those profits turned out to be based on mispriced risk, on bad loans that eventually defaulted, the losses were borne by shareholders, taxpayers, and the broader economy, not primarily by those who'd collected the bonuses. This asymmetry, privatized gains and socialized losses, seems fundamentally problematic. It creates incentives for risk-taking that serves private interest while imposing public costs. Yet solving this asymmetry is difficult. You can't easily claw back bonuses paid years earlier. You can't imprison executives for bad business decisions if those decisions weren't criminal. You can regulate more strictly, but regulation has costs and limitations. There's also a deeper question about whether human judgment and market discipline can reliably govern systems of such complexity. The financial system in 2008 was so complex that probably no one fully understood it. The interconnections between institutions, The nested layers of securities, the mathematical models, the global linkages, the whole system had evolved beyond human comprehension. When systems become too complex to understand, they become fragile. Small changes can cascade unpredictably. Risks that seem diversified and distributed can suddenly concentrate. Models that work under normal conditions can fail catastrophically under stress. We've built a financial system that may be beyond our ability to safely manage. This complexity is partly intentional. Complexity makes regulation more difficult, creates opportunities for profit in the gaps and obscurities, allows institutions to engage in activities they might not be able to defend if presented simply and clearly. But complexity also emerges organically from innovation, from global integration, from the interaction of many institutions and markets. Can we simplify finance without sacrificing beneficial innovation? Can we maintain global integration while ensuring local resilience? Can we preserve market discipline while preventing systemic crises? These questions don't have obvious answers. The crisis also invites contemplation about human nature and economic systems. We designed capitalism to harness self-interest for social benefit, to let individuals pursuing profit generate innovation and prosperity. And this has worked remarkably well in many contexts, producing extraordinary increases in living standards and technological progress. But the crisis demonstrated limits to this mechanism. Self-interest, when aligned with perverse incentives, can produce collectively destructive outcomes. Markets, under certain conditions, can become destabilizing rather than stabilizing forces. Invisible hands can strangle as well as guide. This doesn't mean capitalism is fatally flawed or should be abandoned. But it does mean we need wisdom and humility about what markets can and can't do, where regulation is necessary, how to structure incentives to align private and public interest. Perhaps the deepest lesson is about the relationship between freedom and responsibility, between innovation and stability, between efficiency and resilience. We want financial systems that are dynamic and innovative, that adapt to changing needs and opportunities. But we also need systems that are stable and resilient, that can absorb shocks without collapsing. Balancing these values is the permanent challenge of financial regulation and economic policy. Too much freedom produces crises. Too much control stifles innovation and growth. Finding the right balance requires constant adjustment, learning from experience, maintaining vigilance about emerging risks. As we move into the closing section of our documentary, carry these questions with you. They don't have final answers, but contemplating them helps us understand not just what happened in 2008, but what it means for how we organize economic life, how we govern finance, how we balance competing values in complex systems. In the quiet aftermath of the crisis, once the panic subsided and the cleanup began, people started asking not just what happened, but how we convinced ourselves it wouldn't happen, how smart people made such destructive decisions, how entire societies embraced delusions that seem obvious in hindsight. The stories we tell ourselves matter enormously. They shape what we see as possible, what we consider risky, what we accept as normal. And in the years before the crisis, we told ourselves several stories that turned out to be dangerously wrong. We told ourselves that housing prices always go up. This wasn't quite true even historically. There have been regional declines, periods of stagnation, occasional national dips. But the broader pattern over decades seemed clear. Real estate appreciates, especially in desirable locations with growing populations. This story made borrowing against home equity seem safe, made risky mortgages seem reasonable, made housing speculation seem prudent. The story had just enough truth to be plausible. Over long periods, housing does tend to appreciate, at least nominally. But tends to appreciate over long periods is very different from always goes up, and that distinction mattered enormously when prices began falling. We told ourselves that financial innovation had made the system safer. Securitization was supposed to distribute risk, to spread exposure across many investors, to ensure that no single institution's failure would matter systemically. Derivatives were supposed to allow precise risk management, letting institutions hedge exposures and protect themselves. Mathematical models were supposed to capture risk scientifically, quantifying uncertainty in ways that human judgment couldn't. These innovations did have genuine benefits. Securitization did allow broader risk distribution. Derivatives did enable hedging. Models did provide useful risk measurements, but they also created new vulnerabilities, new channels for contagion, new opportunities for mispricing risk. Innovation had made the system more complex, more interconnected, more opaque, and in important ways more fragile rather than safer. We told ourselves that markets were self-correcting, that rational actors pursuing self-interest would naturally avoid excessive risk, that government regulation was usually unnecessary and often harmful. This ideology, particularly strong in the decades before the crisis, trusted markets to discipline themselves, to punish foolish risk-taking through losses, to reward prudence through profits. This story had intellectual credibility, rooted in economic theory and historical observation. Markets do often self-correct. Profit motives do often align with prudent behavior. But the crisis revealed limits to this mechanism, situations where individual rationality produces collective irrationality, where competitive pressures push everyone toward excessive risk, where short-term incentives overwhelm long-term prudence. We told ourselves that America was different, exceptional, that our economy was fundamentally sound, that crises were things that happened elsewhere, in Latin America, in Asia, in emerging markets with weak institutions and poor governance, but not here, not to us, not to the world's largest and most sophisticated economy. This exceptionalism was comforting but dangerous. It made us blind to vulnerabilities, dismissive of warnings, convinced that problems couldn't really be that serious. When housing prices began falling, when foreclosures started rising, many observers insisted this was temporary, localized, manageable, because severe crises didn't happen in America. We told ourselves stories about home ownership too, that it was always good, always worth striving for. A marker of success and stability and belonging. These stories had cultural and political power beyond their economic logic. They made it seem natural to encourage home ownership, even for people who might be better served by renting, who might not be financially prepared for the risks and responsibilities of ownership. The American dream itself became entangled with home ownership in ways that made questioning this connection seem almost un-American. If you believed in America, if you believed in opportunity and prosperity, you believed in home ownership. This cultural story amplified economic incentives, making it harder to see that maybe not everyone should buy, that maybe some of the new mortgage products were dangerous, that maybe the boom was unsustainable. Financial professionals told themselves stories about their own sophistication, their ability to understand and manage risks that others couldn't grasp. The quants at investment banks, with their PhDs in physics and mathematics, believed their models captured reality with scientific precision. The traders believed their experience and instincts would protect them. The executives believed their institution's size and diversification made them resilient. This confidence wasn't entirely unjustified. These were often smart, capable people with genuine expertise. But expertise in certain domains doesn't grant wisdom about systemic risks, about emergent properties of complex systems, about the limits of models and the fallibility of human judgment. Perhaps the most seductive story was about prosperity itself, the belief that we had figured out how to sustain permanent growth, low unemployment, rising asset prices, and moderate inflation simultaneously. This was the, quote, 13-year period from the mid-1980s through 2007, when economic volatility seemed to have declined, when recessions became milder and less frequent. The Great Moderation seemed to demonstrate that modern monetary policy, global trade, financial innovation, and sophisticated economic management had tamed the business cycle. This story made risk-taking seem safer, made leverage seem prudent, made concerns about unsustainability seem pessimistic or outdated. All these stories contained elements of truth, which is what made them so compelling and so dangerous. The most effective delusions aren't complete fantasies but partial truths, facts selected and arranged to support comforting conclusions while ignoring uncomfortable complications. Breaking free from these stories required painful recognition that we had been wrong, that our confidence had been misplaced, that our sophistication had masked ignorance, that our prosperity had been partly illusory, built on borrowing and speculation rather than sustainable wealth creation. Even now, more than a decade later, we're still telling ourselves stories, still constructing narratives that make sense of our current economy and financial system, still potentially missing vulnerabilities that will be obvious in hindsight after the next crisis. The challenge is not to stop telling stories. We can't help but construct narratives to make sense of complexity, but to hold those stories more lightly, to question them more rigorously, to remain open to evidence that contradicts our comfortable assumptions, to cultivate the humility to admit when we're wrong. When something as consequential as the 2008 financial crisis occurs, disrupting millions of lives and reshaping economic and political landscapes, humans naturally search for meaning, for lessons, for understanding that makes the suffering seem purposeful or at least comprehensible. This search for meaning takes many forms. Some people found political meaning, seeing the crisis as vindication for their ideological positions. Those on the left saw confirmation that capitalism without regulation leads to disaster, that greed unchecked destroys societies, that stronger government oversight is necessary. Those on the right saw confirmation that government intervention in housing markets through Fannie Mae and Freddie Mac created the bubble, that easy money from the Federal Reserve inflated asset prices, that the crisis demonstrated the failure of government, not markets. Both narratives contain some truth. The crisis did demonstrate risks of underregulation and the dangers of concentrated financial power. It also revealed problems with government-sponsored enterprises and monetary policy. But reducing the crisis to a simple political parable misses its complexity and allows people to avoid uncomfortable questions that don't fit their ideological frameworks. Some people found religious or spiritual meaning, interpreting the crisis as divine judgment on materialism, on greed, on a society that had strayed from proper values. This interpretation offers comfort by placing events within a larger moral framework, by suggesting that suffering serves a purpose, by implying that returning to virtue will prevent future crises. Others found personal meaning through the crisis, using their experience of loss or hardship as catalyst for life changes, shifting careers, reassessing priorities, developing resilience, appreciating what matters beyond money. For these individuals, the crisis became a transformative experience, painful but ultimately productive for personal growth. There's also a search for villains, for people to blame, which satisfies the human need to assign responsibility and to believe that removing bad actors would prevent recurrence. Some blamed mortgage brokers who approved predatory loans. Some blamed investment bankers who created toxic securities. Some blamed rating agencies that blessed those securities with false confidence. Some blamed regulators who failed to prevent the bubble. Some blamed homeowners who borrowed irresponsibly. All these actors bear some responsibility. But focusing too narrowly on individual villains misses systemic causes. The crisis wasn't primarily about bad people, but about problematic systems and incentive structures that encouraged collectively destructive behavior while rewarding participants individually. The search for silver linings is another form of meaning-making. People want to believe that good came from the crisis, that we learned valuable lessons, that the pain served some purpose. And there is truth here. Regulations were strengthened, banks are more resilient, some problematic practices were curtailed, awareness of systemic risk increased. But we should be cautious about too much optimism. The human cost was enormous and unnecessary. Many reforms have been weakened or rolled back. Financial industry behavior hasn't transformed fundamentally. Whether we've truly learned lessons or simply applied temporary fixes that will erode over time remains uncertain. There's also a tendency toward historical narrative tidying, creating clean stories with clear beginnings, middles and ends, with identifiable causes and consequences, with lessons that follow neatly. This documentary itself participates in this tidying, organizing complex, chaotic events into chapters and themes, creating coherence that may overstate our understanding. Reality was messier than any narrative can capture. Causation was complex and multifaceted. Events were contingent, dependent on specific decisions that might easily have gone differently. Outcomes remain uncertain, with long-term consequences still unfolding. Perhaps the most profound meaning-making involves accepting the limits of control and the persistence of uncertainty. The crisis revealed that our elaborate financial systems, our sophisticated models, our confident expertise, all were insufficient to prevent catastrophe. We don't fully control economic forces. We can't eliminate risk through clever engineering. We can't model away uncertainty. This is uncomfortable but important wisdom. It suggests humility about what we know, caution about claims of having solved fundamental problems, recognition that surprise and crisis are permanent possibilities, not aberrations we can eliminate through sufficient cleverness. It also suggests the value of resilience over optimization, of building slack into systems, of accepting some inefficiency as the price of stability, of prioritizing the ability to survive shocks over maximizing returns in calm conditions. The search for meaning can also become unhealthy if it leads to conspiracy theories, to seeing malevolent design where there was mostly accident and stupidity, to believing that secret cabals control events, rather than acknowledging that complex systems often produce emergent outcomes that no one intended or wanted. The crisis wasn't orchestrated by evil masterminds. It emerged from the interaction of many actors pursuing their interests within flawed systems, amplified by feedback loops and cascading failures. This is less satisfying narratively than conspiracy theories, but more accurate and more useful for preventing future crises. Ultimately, the meaning of the crisis is what we make of it, the lessons we choose to learn, the changes we decide to implement. the values we recommit to or revise. There's no objective meaning waiting to be discovered, only subjective meanings we construct through interpretation and action. For some, the crisis meant loss without redemption, suffering without purpose, years stolen that can't be recovered. Their search for meaning may remain unsatisfied, and that's legitimate. Not all pain has meaning. Not all disasters produce growth or learning. Sometimes bad things happen, and all we can do is endure and eventually move forward. For others, the crisis catalyzed changes in how they think about economics, about society, about what matters in life. These subjective meanings, multiplied across millions of people, shape politics, culture, and policy in ways that constitute the crisis's ongoing legacy. As we continue toward the close of this documentary, recognize that your own meaning-making is valid, whatever form it takes. The crisis affected different people differently. Your experience, your interpretation, your lessons learned, these matter. Both for your own life and for the collective wisdom we develop about how to navigate an uncertain economic world. One of the most painful and unresolved questions from the crisis concerns accountability. Did those responsible face appropriate consequences? And what does justice mean in the context of a systemic failure that emerged from so many individual and institutional decisions? The statistical reality is stark. Very few individuals faced criminal prosecution for crisis-related conduct. No senior executives at major Wall Street banks went to prison. The Department of Justice brought some cases against smaller players, particularly for mortgage fraud, but the architects of the mortgage securities and CDOs, the executives who led their institutions into crisis, the regulators who failed to prevent it, these people largely avoided criminal sanction. This absence of prosecutions generated widespread anger and cynicism. If ordinary Americans face prosecution for minor drug offenses or property crimes, why shouldn't bankers face prosecution for conduct that destroyed trillions in wealth and millions of jobs? The perception that there's one justice system for Wall Street and another for Main Street became deeply corrosive to faith in legal institutions. The legal challenge was genuine, though. Most of what happened wasn't clearly criminal. Making bad loans, creating risky securities, receiving AAA ratings for toxic assets, taking excessive leverage, these were terrible business decisions with catastrophic consequences, but they weren't obviously illegal. Prosecutors need to prove criminal intent beyond reasonable doubt, a high bar to clear when defendants can argue they believed the models, trusted the ratings, thought the risks were manageable. Some conduct clearly crossed into fraud, mortgage brokers falsifying loan applications, appraisers inflating valuations, borrowers lying about income. And prosecutions did occur in these cases, though they mostly targeted lower-level actors rather than senior executives who benefited most from the fraudulent system. The few major cases that were brought often resulted in settlements rather than trials. Banks paid enormous fines, billions of dollars in aggregate, but these fines came from shareholder funds, not from the personal wealth of the executives who made the decisions. The executives themselves often departed with golden parachutes, large severance packages that rewarded them for failure. There's also a question about regulatory and political accountability. Federal Reserve Chairman Alan Greenspan, who championed deregulation and light-touch supervision, retired before the crisis peaked and wasn't held accountable for his role in creating vulnerability. Congressional leaders who pushed for expanded homeownership and resisted regulation faced little consequence. Rating agency executives who blessed toxic securities with AAA ratings kept their positions. Some defenders argue that attempting massive criminal prosecutions of bankers would have been counterproductive, that it would have prolonged crisis and undermined recovery, that the priority had to be stabilizing the financial system rather than seeking punishment. There's some validity to this. In the midst of acute crisis, prosecution is less urgent than preventing collapse. But this pragmatic argument doesn't address the longer-term corrosiveness of perceived injustice. When people believe that elites can commit serious wrongdoing without facing consequences, faith in institutions erodes. Political stability depends on belief that law applies to everyone, that power doesn't grant immunity, that justice is impartial. The crisis also raised questions about moral versus legal culpability. Many actions that contributed to the crisis may have been legal, but were arguably immoral. Approving mortgages to people who clearly couldn't afford them, creating securities designed to fail, betting against securities you're selling to clients. Should these actions, even if legal, face some form of accountability? Professional consequences were limited too. Very few executives faced career-ending repercussions. Some moved to other firms, some retired wealthy. Some continued leading major institutions. The labour market for financial talent didn't seem to penalise crisis participation the way you might expect if market discipline were functioning effectively. There were some instances of accountability. Some executives lost enormous personal wealth as their stock holdings became worthless. Some firms disappeared. Lehman Brothers, Bear Stearns, Merrill Lynch ceased to exist as independent entities. Some shareholders suffered massive losses. This represents a form of market accountability, if not legal or moral accountability. Civil litigation produced some consequences too. Shareholders sued executives for mismanagement and breach of fiduciary duty. Homeowners sued banks for predatory lending. Investors sued over misrepresented securities. These cases resulted in settlements totaling billions of dollars, though again, mostly paid by corporations rather than individuals. The question of what justice would look like remains contested. Should executives have gone to prison? Should banks have been forcibly broken up? Should more aggressive prosecutions have been pursued even if they might have failed to secure convictions? Should new laws have been passed to criminalize conduct that was legal at the time? Different political and moral philosophies give different answers. Retributive justice emphasizes punishment for wrongdoing. Restorative justice emphasizes making victims whole. Consequentialist ethics focuses on outcomes and deterrence. Each framework suggests different approaches to accountability. There's also the challenge of systemic causation. When thousands of people each made decisions that contributed marginally to crisis, who exactly should be held accountable? The mortgage broker who approved one bad loan among thousands, the trader who created one toxic CDO among hundreds, the regulator who failed to see emerging risk, the politician who championed homeownership expansion? Perhaps the most honest answer is that the justice system, designed primarily for individual wrongdoing, struggles with systemic failures involving diffuse causation and complex technical violations. The law isn't well equipped to assign accountability for collective folly, for emergent crises, for failures that result from thousands of individually defensible decisions that prove catastrophic in aggregate. This doesn't mean accountability is impossible, but it suggests we need better frameworks. Perhaps administrative penalties, professional sanctions, regulatory reforms, cultural changes in finance, beyond traditional criminal prosecution to address conduct that contributes to systemic risk. The absence of clear accountability has costs beyond unsatisfied justice. it creates moral hazard for future crises. If executives know they won't face serious consequences for decisions that generate profits in good times and catastrophe in bad times, they have reduced incentive to avoid excessive risk. The implicit message is that you can collect bonuses during the boom and avoid punishment during the bust. Whether this lack of accountability will prove costly in enabling future crises, or whether other reforms have sufficiently strengthened the system regardless of individual consequences, remains an open question that will be answered in time, probably through painful experience. As we approach the end of our exploration, we should contemplate how the crisis permanently transformed economic life, not just through immediate impact, but through lasting changes to behavior, attitudes, institutions, and expectations that persist more than a decade later. The relationship between citizens and financial institutions fundamentally changed. Before the crisis, banks enjoyed substantial trust. People deposited money confidently, assuming safety. They accepted financial advice relatively uncritically. They believed that sophisticated institutions knew what they were doing. After the crisis, that trust evaporated or diminished dramatically. Surveys show persistent distrust of banks, of Wall Street, of financial institutions generally. This manifests in various ways. People keeping more cash, being more skeptical of the investment advice, choosing smaller local banks or credit unions over large national banks, demanding more transparency and simpler products. This distrust extends to expertise more broadly. When sophisticated models and smart people with impressive credentials got things so wrong, why should we trust expertise in other domains? This skepticism is both understandable and potentially dangerous, as it can slide into rejection of legitimate expertise, into believing that ignorance is as valid as knowledge. The crisis also transformed housing market psychology. The assumption that housing prices always increase, which fueled the bubble, has been shaken. Homeownership rates have declined from their pre-crisis peaks. Younger people are delaying or avoiding home purchases, viewing home ownership as riskier and less financially essential than their parents did. This represents a cultural shift with broad implications. If fewer people buy homes, if households remain more mobile, if real estate represents a smaller share of household wealth, the economic and political landscape changes. The housing industry contracts, suburban development slows, political coalitions organized around home ownership interests weaken. Labor markets were transformed too. The long period of elevated unemployment following the crisis, particularly youth unemployment, damaged career prospects for an entire generation. People who entered the workforce during the crisis faced lower initial wages, slower career progression, reduced lifetime earnings. These scars persist years later, affecting consumption patterns, family formation. Political attitudes. The crisis accelerated trends toward income inequality that had been developing for decades. Capital recovered faster than labor. Stock market gains benefited primarily the wealthy. Wage growth remained weak, while corporate profits rebounded. The gap between rich and poor, already concerning, widened further. This inequality has political consequences we're still experiencing. Populist movements on both left and right emerge partly from crisis-related anger and economic insecurity. Traditional political coalitions fractured. Trust in democratic institutions declined. Political polarization intensified. The crisis also transformed central banking. Before 2008, central banks mainly adjusted interest rates, maintained financial stability in background ways, operated somewhat independently of political scrutiny. After the crisis, central banks became much more interventionist, using unconventional tools like quantitative easing, becoming more politically visible and controversial. This transformation raises questions about central bank independence and democratic accountability. When central banks make decisions that dramatically affect wealth distribution, that influence which assets appreciate and which don't, that determine who wins and loses economically, should they remain insulated from political oversight? Or does democracy require more accountability for such powerful institutions? Fiscal policy also changed, though less coherently. The crisis demonstrated that government spending during recessions can prevent economic collapse, but it also created political resistance to debt accumulation that complicated subsequent policy. Different countries drew different lessons. Some embraced austerity, some maintained stimulus, creating divergent recovery paths. The regulatory landscape transformed significantly. Though unevenly across countries and over time, some regulations have been strengthened and maintained, others were implemented then partially rolled back. The trend has been toward more regulation than existed pre-crisis, but less than crisis urgency initially produced. Globally, the crisis accelerated shifts in economic power. Emerging markets, particularly China, strengthened their relative positions. The American financial system's prestige declined. European integration faced strains that persist. The crisis revealed and amplified longer-term trends toward a more multipolar economic world. Technology's role in finance increased dramatically post-crisis. Financial technology companies, offering alternatives to traditional banking, grew rapidly. Mobile payments, peer-to-peer lending, cryptocurrency, algorithmic trading, all expanded in crisis aftermath, partly enabled by low interest rates, partly driven by distrust of traditional finance. These technological changes bring new opportunities and new risks. They may democratize finance, making services more accessible and cheaper. They may also create new vulnerabilities, new channels for crisis, new regulatory challenges that we're only beginning to understand. The crisis also affected how we think about economic risk and uncertainty. The comfortable belief that we had achieved economic stability, that modern policy tools had tamed business cycles, that sophisticated risk management had made finance safe, all these beliefs were shattered. We relearned that uncertainty is irreducible, that confidence can be misplaced, that apparent stability can conceal building vulnerability. This relearning has produced both healthy caution and potentially excessive pessimism. Some skepticism about financial innovation is warranted, but too much caution can prevent beneficial development, can trap us in familiar patterns even when new approaches might be better. Educational responses emerged too. Economics curricula were revised to include more attention to financial crises, to behavioral economics, to systemic risk. Business schools incorporated more ethics education. Regulatory agencies invested in training and expertise. Whether these educational changes will produce fundamentally different behavior in future crises, or whether each generation must learn through painful experience, remains uncertain. Human nature hasn't changed. Incentive structures remain powerful. The tendency toward bubble and bust cycles may be inherent in market economies, regardless of education. Perhaps the deepest transformation is psychological and cultural, a shift from confidence to caution, from believing in progress to expecting fragility, from trusting institutions to questioning them, from optimism about our ability to manage complexity to humility about our limitations. This shift affects everything from personal financial decisions to corporate strategies to policy choices. Its long-term implications will unfold over decades, shaping the economic world in ways we're only beginning to understand. And so we arrive at the end of our long journey through the 2008 financial crisis, having travelled from its origins in housing markets and mortgage lending, through the panic of autumn 2008, into the long recovery and lasting transformations, and finally to contemplation of what it all means. What wisdom can we claim to have gained from this experience? The honest answer is, less certain wisdom than we might hope, more uncertain understanding than we might like. We know that housing bubbles can form and burst, that financial innovation can create risk while claiming to reduce it, that interconnection can transform isolated problems into systemic crises, that regulatory frameworks struggle to keep pace with market evolution. We know that confidence can evaporate suddenly, that liquidity can disappear when most needed, that mathematical models can fail catastrophically, that even sophisticated institutions can misunderstand their own exposures. We know that crises impose enormous human costs that extend far beyond Wall Street offices and trading floors into ordinary lives, ordinary families, ordinary communities. We know that recovery from financial crises is typically slow and painful, that scars persist long after acute symptoms subside, that some damage may prove permanent. We know that prevention is vastly preferable to cure, that avoiding crises is better than managing them, but also that prevention requires vigilance against forces that constantly push toward complacency, toward excessive risk-taking, toward believing that this time is different. We know that no single reform, no single regulation, no single institutional change can eliminate the possibility of future crises. The financial system is too complex, too adaptive, too globally interconnected for simple solutions. Eternal vigilance and constant adjustment are necessary, not as failures of past reforms, but as acknowledgements of permanent challenges. We've learned perhaps to be suspicious of claims that we've solved fundamental problems, that we've achieved lasting stability, that we've mastered risk through clever engineering. History suggests that such confidence usually precedes disaster, that believing we've conquered uncertainty is itself a dangerous delusion. We've learned the value of simplicity in some contexts, the danger of complexity that exceeds our ability to understand, the importance of maintaining systems that can be comprehended and managed by humans rather than only by mathematical models. We've learned that incentives matter enormously, that compensation structures influence behavior powerfully, that aligning private interest with public good requires constant attention and recalibration. We've learned that time transforms memory, that as distance from crisis increases, lessons fade and old patterns resurface, that each generation may need to learn through its own painful experience what previous generations learned through theirs. But perhaps most importantly, we've learned, or should have learned, humility. Humility about how much we can know, how well we can predict, how effectively we can control complex economic systems. Humility about the limits of expertise, the persistence of uncertainty, the inevitability of surprise. This humility shouldn't produce paralysis or nihilism. We can still act, still build institutions, still make progress in reducing vulnerability and managing risk. But we should do so knowing that perfection is impossible, that future crises will occur, that our best efforts will prove insufficient in ways we can't currently imagine. Moving forward requires balancing multiple values that can't all be maximized simultaneously: innovation and stability, efficiency and resilience, freedom and regulation, growth and sustainability. Different societies will strike different balances, and those balances will shift over time as conditions change and priorities evolve. It requires maintaining attention to systemic risk, even when everything seems calm, even when maintaining vigilance seems costly and unnecessary, even when voices argue that regulations are burdensome and should be relaxed. It requires remembering that behind economic statistics are human lives, that policy failures impose real suffering on real people, that abstractions about market efficiency or regulatory burden translate into concrete experiences of job loss, foreclosure, poverty, and despair. And perhaps it requires a fundamental shift in how we think about economic life. Less as a machine to be optimized for maximum output, more as an ecosystem to be managed for sustainability and resilience, less as a competition to be won, more as a collective challenge to be navigated together. The 2008 financial crisis was, in many ways, a story of forgetting that bubbles burst, that risks materialize, that confidence can be misplaced, that systems can fail. Our task moving forward is not to achieve certainty or eliminate risk, but to remember these lessons even when circumstances make forgetting tempting, to maintain caution even when others profit from recklessness, to preserve wisdom through time even as it becomes less immediately relevant. Closing 147 to 150. We've travelled together now for 2.5 hours through one of the most consequential economic events of our lifetimes. From mortgage brokers and home buyers to Wall Street traders and central bankers, from Main Street suffering to global contagion, from the seeds of crisis through its devastating bloom and into its long aftermath. Thank you for staying with the exploration, for giving your time and attention to understanding something complex and often painful. This was a long journey, but the crisis itself was long too, and its effects continue still. Where in the world are you right now as we close? Perhaps you've drifted off already, your breathing slow and steady, your consciousness settling into rest. Perhaps you're still listening, thinking about what this all means, connecting it to your own experiences of these years. Wherever you are, whatever your relationship to the crisis, whether you lived through foreclosure or job loss, whether you watched from relative safety, whether you are too young to remember, your presence here has meaning. The question we posed at the beginning was whether greed broke the world economy. The answer, as honestly as I can give it, is partly yes. But not only greed. Greed played its role, certainly, in incentivizing risky lending and complex securities, in pushing for deregulation, in pursuing profit without adequate attention to risk. But the crisis also emerged from collective delusion, from systemic complexity, from behavioral biases, from regulatory failures, from the interaction of many forces and many decisions by many people, most of whom thought they were acting reasonably. Understanding this doesn't excuse the harm that was done or the suffering that was imposed. It doesn't absolve those who made terrible decisions from responsibility, but it does suggest that preventing future crises requires more than simply punishing bad actors or eliminating greed. It requires structural changes, institutional reforms, cultural shifts, sustained vigilance, and the humility to recognize that we will never fully eliminate risk or perfectly manage complexity. If you found value in this slow drift through economic history, if these careful explorations help you understand our world and perhaps sleep more peacefully despite that understanding, I hope you'll share this with others who might benefit. A like, a subscription, a comment sharing your thoughts or your own experiences, all of these help build this community of thoughtful people seeking to understand difficult subjects through calm, measured examination. Wherever you are in the world, I hope you're comfortable now, your body relaxed, your mind quiet or quieting, the concerns of the day releasing their grip. I hope your breathing has slowed, deep and steady, filling your lungs completely, then releasing slowly, carrying tension away with each exhale. I hope the story we've explored together, while serious and sometimes sad, has ultimately brought you some peace, some understanding, some sense that complexity can be comprehended, that difficult questions can be approached thoughtfully. Look up at the ceiling if you can, or imagine it if your eyes are closed. Consider all the structures above you, the roof keeping weather out, the floors of apartments above if you're in a building, the sky beyond all that. Those structures, like the economic structures we've discussed, are built by human hands and human minds, serve human purposes, require maintenance and attention, can fail if neglected, but can also endure and shelter us when properly maintained. All those structures, physical and economic, exist because people created them, worked to build them, learned from failures and successes, adapted and improved over time. The financial system, for all its flaws and failures, still serves important purposes, connecting savers and borrowers, managing risk, facilitating trade, enabling commerce. The crisis revealed its vulnerabilities, but the basic functions remain necessary. And perhaps that's the ultimately peaceful thought to rest with, that systems can fail and be rebuilt, that we can learn from catastrophe, that resilience is possible even after terrible damage, that human creativity and effort can address even terrible problems if we maintain commitment and wisdom. The crisis was painful and destructive, but it wasn't the end of the world, wasn't final, wasn't without lessons or possibility for improvement. Sleep well. Dream, if you dream, of economies that serve human needs rather than dominating human lives, of financial systems that balance innovation with stability, of societies that protect the vulnerable while encouraging the ambitious, of wisdom being maintained across generations, of lessons learned being lessons remembered. Good night.